Hey guys, welcome. Good evening to another money space with me, Kalu Aja. On here, we're talking money, the economy, and of course, personal finance. And we've got a show today. We're going to talk around the public offers that the banks are doing. Not just that, I want to explain to you how you can look at public offers or offers in general and sort of have a baseline valuation. Like, how can you look at this offer and say, hey, this is good. Hey, this is something I want to get into. What are the criteria you should look at? That's what I want to do today, right? Just to make it really, really simple language, just so you can follow. So I've got Olumide here, Olumide Capital here. He's graciously agreed to come in and just so we can have a discussion. I want to make it very, very educational. That's a key word. So it's not investment advice, guys. It's educational because we've got lots of requests, people saying, should I buy this stock? Should I buy that public offer? What does it all mean? Why are they raising capital? Hence, we're doing this space. Olumide is here as a co-host on this educational space. Olumide, you want to unmute and say hi?
Yeah, thanks, Carlo. Thanks for the invite. And yeah, good to be here. Interesting session going to be. I think for listeners, I think I'll put a disclaimer. Like Carlo highlighted, it's mostly educational. The reason is because this industry is heavily regulated, and it's not our job to give investment advice to the public. It's the job of an investment bank. But we really just want to have the perspective of how people should really look at why companies do these things and what is happening in this sector. So the concerns that now investment, bank investment, stocks, all those things, we'll talk about it. So thanks for inviting me to the program once again.
Okay, Olumide, I think a great place for us to start, Olumide, is to say, hey, just overall, I think one question I get people are asking as specific to the bank offers, why are the banks raising capital? Because we're in industry, we understand why, but perhaps we could explain why are all the banks suddenly raising capital? What's the reason?
Okay, good question. So the major reason why banks are raising capital is the new CBN recapitalization policy on banks. You recall, Cardoso highlighted during his introduction to being the CBN's salesman that he really wants to make our banks relevant, particularly to meet the 1 trillion economy agenda, which President Tinubu was working on. And you understand that banks raise money for different reasons, but it's really the best place to get money from, to get money easily. And also because the market is much efficient than other channels, banks prefer that channel. So you've seen that a lot of banks are already out. We had some few successful completions. Fidelity completed their because they were the first to come to the market to need quite this amount of money. But we still see other banks coming in. So basically, it's just to meet their capitalization metrics. Some banks say that they want to invest in technology like GT. Other banks like Zenith, they're talking about really expansion. We see Zenith already in Paris, in France. So different purposes, but generally, the general crowd objective is that they want to be able to meet their capitalization objective easily.
Gotcha. And of course, Olumide, we know that like any company is funded through two sources. There's debt, which is borrowing money. There's also equity, which is, like you said, raising capital from new investors to then use to fuel that growth in the company. So in this case, the Central Bank of Nigeria has mandated that all Nigerian banks have to raise their equity, i.e. the owners of the bank, which is the shareholders currently in the bank, have got to bring in more money into the bank. And the bank, CBN is doing that because, like you said, they want to position the banks to participate in this $1 trillion economy that's going to come. So you can't have a $1 trillion economy and have banks capitalized at maybe 200 million naira. It won't make sense that much. So CBN is saying, hey guys, up your take and let's go. So then you mentioned public offer, you mentioned rights offer. Let's just talk about the differences. What's the public offer? What's the IPO? What's the rights? What's the connection?
Good question. Public offer generally, in simple terms, just means how companies raise equity and bonds. We call that securities. Equity and bonds are securities at the open market. So when you hear initial public offer, it's the first time a company is going through that channel. So it's called an initial public offer. Then when it has happened before, secondary, we see right issue. So there are different reasons, like why Carlos said right issue. Sometimes a company might decide to just go through the right issue so that to discourage share dilution, because usually when a company's shares is diluted, if you use the earnings per share, then you have more investors in. But in public offer, secondary public offer, new investors can come in. So you could see that some banks are doing a mixture. And the advantage is that you get, if for right issues exposure, you get, for those that have shares in that entity, you get a discount. That's how it should work normally. It's supposed to be at discount. So it makes that incentive to get more. So basically, that's really how it works. I hope I was too busy. I was trying to make it so simple as possible.
Don't worry. So I mean, it's more like like you said, the first time he raises capital, that's the initial public offer, IPO, that we all hear about, right? Then when it goes to the market, that's public offer. But if it's going to the market for only its existing shareholders, that's a rights offer. Yeah. And we're going to use FCMB as a case, so just so we can say, okay, FCMB is doing this, or Fidelity is doing that. So FCMB today is doing a public offer, right? Which means that they are offering these shares. So let me look at the prospectus, because there are some keywords I want to highlight there. Number one, it's an offer for subscription, if I'm correct, which means that they are asking investors to come and subscribe, i.e. buy new shares, right? Buy new shares that will be created. New shares are going to be created when you do this. If you remember, if you pull up the Dangote cement, you see it was an offer for sale. That meant that Dangote already owned the shares. Those shares already existed, but he's selling what he owns. In an offer for subscription, the bank is going to create brand new shares and it's going to sell to whoever subscribes. So it's an offer for subscription, public offer. It means anybody in the public can buy, like Olumide. And it differs from a private placement where only private investors, or you can't go and advertise. So that's basically the key difference there.
Yeah, but just to right issue is also a form of public offer, but right issue is targeted at existing investors, so people don't mix it up. Because you need to understand that for you to take part in the right issue, you must be an existing investor in that company. I just wanted to highlight that. So, go on.
Perfect. And then if we look at the prospectus, we're saying that the share, FCMB is offering about, is that 15 billion shares? No, 15 billion shares at 50 kobo each. Look at the keyword here, at 50 kobo each. But it's selling those shares at 7 naira 30 kobo. So Lumide, what's that 50 kobo? Why can't I buy the shares at 50 kobo? What's that 50 kobo doing there?
That's the original placement. No, so it's common. Those shares listed are common, right? So that's the original. The price. The price is selling. The price is selling right now. It's around
7.30.
So, no, right now in the stock market, it's 7.65 kobo at the stock market. So the price FCMB is giving now is a discount. I think last time I checked was between 10 to 15%.
Okay. And again, guys, when you buy this share, look at the key difference again we're emphasizing. When you buy the public offer from FCMB, the money you invest is going to the bank. The bank can use this money to then grow. If you buy the shares on the floor of the stock market, the money is not going to the bank. You are simply buying from an investor. So the bank doesn't get those funds to grow and expand. So if you are a customer of FCMB, if you want to invest in FCMB, you are saying you want to buy the public offer, or even if the company, for instance, did a rights issue, you want to participate in that rights issue because you want your funds to go to the bank, so the bank can then use those funds and then expand. And we're going to come to those use of funds in a second. So we've now understood why the bank is raising more funds because of CBN. We understand it's a public offer. We understand it's an offer for subscription. We've seen the par price, which is 50 kobo. Then the offer price of 7 naira 30 kobo. And look there, I said on the floor of the exchange, it's at a higher price. So if you buy based on the public offer, it's a slight discount if you're buying. So that's first put there. And then this offer, go ahead.
Then I just want to add something. So just like you highlighted, people need to understand why FCMB looks peculiar in this introduction and why we are talking about FCMB. So you see, every investor has different objectives and goals for investing. The average Nigerian really wants to, because we have a young population, they are looking at growth assets. But you really need to look at why FCMB looks catchy here. So if you look at the 52-week high of FCMB, it was 12.45 kobo. Then you also look at the 20 years chart. You look at I'm looking at market tactician. Can't look more like a fundamental. So let me look at the market for you guys. So if you look at the market spectrum, for example, the best time for FCMB was 2006, when the stock looked like it was going to hit the 29 mark. But right now, the 52-week high was best attained in this year, January 10, when the stock hit 12.5 kobo. If you look at the 52-week low, that was August 30, 2023. So you look at the event, it was when President Tinubu, after President Tinubu came to power, and banks then clarity, FX, lack of clarity in the FX market really pushed the bank stocks mid-range. So you could see that that was one of the reasons why tier 2 banks, particularly FCMB, had that share drop. Now, the stock price right now is at 7. So you're getting about 40% discount when you look at it from the 2-week high. But the reason why people consider tier 2 banks ahead of tier 1 banks, particularly ZNGT, is that the opportunity to grow is faster. And you look at the numbers, for example, in 2022, let's forget devaluation and inflation for now. I will go to adjust that later. If you look at 2022, the stock was trading at around the 3.5 to 4 naira bandwidth. Now, if you look at 2020, when COVID hit, the stock was floating around 2 naira. But it has been having a trajectory upside projection. If you put a graph, you see that it has been going up. So one of the reasons are the fact that the bank has been expanding, bringing new products. It looks like a tier 2 bank on paper, but it behaves like a tier 1 bank in principle. And I'll tell you why, because it also has exposure in the foreign markets like the United Kingdom. It has a wholesale banking license, and they have investment exposure. Then if you also look at the fact that Shuguru Balogun, they have found out what happens to the debt, so rest in peace. He's one of the guys that have a particular characteristic we call old money. This is a Baba Ijebu man that really had passion for banking, and he grew his tentacles through the banking system, trying to create something of value without government and foreign support. In fact, it's the first Nigerian bank to be created without government and foreign support. Then, if you also look at the fact that when Baba Soludo came, the CBN, that was one that really brought transformation in our banking. I bet against FCMB because I thought that they did not have the liquidity. I was here for a shocker. They came in through. So the fact that they could raise funds through the primary and secondary market was a a deep applause for them.
Deep call to
And
action for you.
yeah, and also the fact that they've also been able to diversify the investment. You see, they have a very strong investment arm in terms of stockbroking, investment banking. So don't be surprised when their MD, Edwin, she's one of an outstanding investment professional. So I need to give you guys the way market is reading. So if you are looking at it now, uh, you see that the dividend yield is 6.54%. You look at the fact that the stock is heavily floated. So when I say heavily floated, it means that it's quite liquid. You see, one of the problems we have in the Nigerian stock market is that there are a couple of stocks you buy, it becomes very difficult to sell. And it's not because the companies are, because our market is quite inefficient. How many Nigerians can really invest? So one of these you look at from the basics. I think I put it under Carlos' space for those that want to read. Is banks are naturally liquid because they are heavily floated on the exchange. So more than 80% of the stock is readily available for investors. So it's very easy to sell at fair value, which is a plus. Then you look at the earning per share. It's not the highest, but definitely it's not the lowest, and it's quite median among its peers. It has earning per share of 8.82. So I need to highlight these concerns for you guys to look at how the market is viewing the stock. Now, can the stock hit a 20 naira? Well, if you look at the market, look at the chart, the possibility is there. But when you look at a GT, for example, or you look at Zenith, GT, Zenith, these are top banks in Nigeria. But when you look at the market, the price, look at the market, it's very difficult for a GT to hit 100 naira per share. You've seen the times that GT oftentimes has hit the 50 naira mark 3-4 times and bounced back and retraced. And that's because the kind of investors that own GT stock are more institutional and conservative. So they look more on the passive dividend. They are not really the coming. No. So it's a stock you need to understand. So, but if you look at FCMB, it's a mixture of institutional investors and retail investors because the stock price is less than 10 naira. Trust me, you can't even buy a sachet of pure water for 10 naira. So you imagine the kind of investors you see here, you see different kind of investors. So you need to understand why the uniqueness of that asset when you are investing. I hope I do myself clear.
I think you get a broad overview, which allows us to go into the stock in detail, or the company or the group. It's FCMB Group. Let's go into detail on there. I like the fact that you mentioned that this was the first Nigerian indigenous financial, should we say, player. They were the first Nigerian indigenous stockbroker, FCMB Group, back then, under the founder. He was the first Nigerian without any government support that set up any sort of financial service industry. I think it was registered as stockbrokers before going into banking. So this is a particular bank that's got history with Nigerians. The other banks that we have that are owned by Nigerians were established, then Nigerians bought into them. So look at the tier 1 banks, First Bank, UBA. These were established banks that Nigerians have now taken over. But FCMB has been Nigerian from day one, even when we didn't have independence. So from day one. Number 2, right? When I look at a company, I ask myself, when the company is raising money, where will the growth come from? Because when you are buying a stock, like nobody has given you the price action, let's look at the fundamental action. When you want to invest in a company, you want to ask yourself a question: where will the future earnings come from? Because the best predictor of stock price is earnings. So if a company is going to earn more, then it's a guarantee that the stock price will go up. So if you want to know which stocks are going to go up, look at their earnings, not just their earnings today, but their future earnings. So you want to ask yourself, when you see a company come to the market, the money they are raising, is it to grow revenues? Will the assets they currently have, look at it, it's 2 questions. Does what they have right now, can they grow revenues into the future to compete? Or they need the money today to buy new assets that will then grow revenues? So we're looking at the value or a growth company. If you go to, say, Chase Bank in the US, they have a lot of assets on ground already. So They are making money from the assets they already have on ground. If they add one new branch in Chase Bank in the US, it's not going to add any marginal increase in their earnings because they will have thousands of branches. It's the same when you come to FCMB. Any naira you put in FCMB, like Olumide has said, as a growth bank, will yield faster than any naira you put in an established bank, because you want to ask a tier 1, a tier 2. The tier 1s have an established base, i.e. branch network, deposit based capitalization. They already have that. So they are growing based on what they already have. So more branches equates to more deposits, which equates to more loans, which equates to more earnings. But when you come to a tier 2 bank, there's a lot of gaps that if they invest in new branches, new IT, new human resources, that adds a higher marginal return than the established bank. So you see what I'm saying? I'm just clarifying what they're saying about tier 1, tier 2 when it talks about GT. And FCMB as a tier 2 bank, keep in mind, FCMB is the 8th biggest bank in Nigeria. 8th. And let me tell you, FCMB has got 10 operating entities. Let me list them out for you. We've got the bank itself, the FCMB group now. We've got the bank, the FCMB bank. You've got the microfinance bank. You've got the credit direct, which issues instant loans to, say, civil servants. And if you have like a salary scheme, you can apply and get a loan instantly. They've got the capital markets. They've got the stockbrokers. They've got the pensions. So long-term access to funds. The pensions, they've got a pension. They've got the trustees. They also have a UK branch. So why I'm listing this for you is this, right? Do you think if you invest in an entity that has got 10 operating entities, that is a tier 2 bank, the 8th biggest bank in Nigeria, one of the largest markets in Africa, do you think an investment of 7 naira would allow this entity to grow earnings tomorrow? That's your question. The price in itself is not the question. The question is, do you think this entity will take your funds and can grow earnings from the funds you are giving it? Because you are asking yourself, if they're already established, they're going to get growth from their established assets. But if this group already, without the capital base, is needing your money, will this allow them to grow marginally faster and broader than the established banks? That's the maths question. Will they come in?
Yeah, so just to summarize what you said, I just wanted to add something. So for listeners, what Carl is just saying is that the bank has a solid subsidiary, investment subsidiary across asset management and investment banking. I think if you look at the origins of FCMB, you know that was their core spread. Then you also look at the fact that they also built a strong presence in retail and one of the key advantages of FCMB, if you look at over the past few years, is that they built relationship with the niche in that space, particularly women, young people, AI, tech. So yeah, that's one. But when you are looking at investment, you also look at the negative and you look at the risk. So if you look at their weakness, operating cost is usually higher for tier 2 bank. You need to know that there's a cost of funding. Yeah, it's cheaper for a GT to raise than the risk a GT will have is lesser than what an FCMB. So when they're going to the market, the cost of definitely reflect on. So it's more expensive. Then you don't get the kind of dividend yield you get from a UPA from an FCMB. But still at that, the opportunities, like Carlos said, is that they grow fast. The return on capital is faster than the average tier 1 bank, you see. And you also need to look at the fact that they are also widening their tentacles outside the local economy. We spoke about UK. Now, the major risk banks face right now is not even banks themselves, is the government. If you look at windfall tax, for example, like I think I did this claim. I have this exposure on all the bank stocks that are listed. All the listed bank stocks. Immediately the windfall tax came to play, I had to reduce my exposure, and the reason was because it was more like hitting on the bank's margins. And if you look at the stock, some of these banks were already trading at least 30 to 40% higher than the present value. So you also need to look at regulatory and macro vulnerabilities, which is very important. But the advantages banks have over other types of stocks is because the liquidity, efficiency, and access to hit the buy and sell is very easy. Unlike you are trading in manufacturing stock, for example, trust me, I'll tell you that it's far easy to sell 100 million shares of a FCMB than a highly capitalized manufacturing company in Nigeria. So these are things you need to look at when you're investing. Can you go on? Thank you.
Yeah, we have a few guys that want to speak in, guys. Remember, if you have a question, you can preferably send a DM or request to speak, and then we'll bring you on. We're just going to round up now so we can open the floor to you guys. Let me give the numbers for those that are out there that like the numbers and like to get the hard data facts. I'm just going to mute this gentleman. So I'm going to, Steven, stay muted, please, if you don't mind. So, in terms of price to earnings ratio, when we say PE ratio, what we're trying to say is how much, if you pay for FCMB today at if for instance you pay for FCMB at today's price, right? What are you getting? You are buying earnings. So when we look at the PE ratio, we're asking a question: how much earnings are you buying if you pay for the price today? In essence, we're saying how overvalued is the company. Because if the company is earning 10 naira and I am paying 1 naira, you see, I'm buying at a discount, right? But if I'm paying 20 naira for a company earning 10 naira, I am paying, above the earnings. You can say times 2 earnings. So the earnings tell you how cheap or how expensive that particular stock is. It's not the price you look at, the earnings. So PE ratio gives you like a picture of how much of the earnings are you paying for. The advantage for FCMB, which is what you want to use when you look at other offers, look at the PE ratio. FCMB is about 1.3 times earnings. At this current price, you are buying the stock at 1.3 times earnings. That is very, very low. The average for Nigerian banks is 7 times earnings. 7 times earnings the average Nigerian banks. So this might look like a discounted offer to you. Again, the PE tells you how expensive the stock is when we look at it via the lens of revenues. What about earnings? If you bought earnings, if you look at the earnings for FCMB, they've grown by about 120% from the past year. So the stock is, or the group is growing. The group is growing. What are negatives? Dividend growth has been unstable. So they could pay high today and not pay high the next day. So unstable dividend growth. The market cap, Lumde has had a hit on that. The market cap is really, really low. So they can't do really massive big ticket items, which is what this public offer is intended to also solve, to equip the bank with the ammunition to enable them then go to the market with a larger capital base and then perhaps participate in more large transactions. If you look at their competitors, Wema, Sterling, Jais, Fidelity Bank, you would say, yes, among all these banks, they should be number 2 in terms of the capital base among that tier 2 bank. They are doing way better. They are punching above their weight when you compare them with a Sterling or a Wema, but maybe below their weight when you compare them with a Fidelity in terms of market cap alone. Look at the price action. Let me touch on the price action. 2024, the stock was up. 2024, it got to maximum about 12 naira. It's now back to about 7 naira and or 7.70. So the price action for the stock is pretty. It's not that volatile. It's not a high beta, but it does move because it's a small. Should we say it's a second tier lower cap stock. So it will move. In terms of the shareholder returns, 1 year shareholder returns for the banks about 28%. For Nigerian banks in general, about 17%. So they are growing faster than the baseline Nigerian banking index because, again, they are smaller. When we say smaller, their capital base is smaller, so they're able to grow faster, right? In terms of, let me say, for 7 days, yes, that's growing faster than the bank for 1 year. So essentially, what you're looking at, guys, if we were to summarize this is a bank that we call tier 2 because we have a tier 1 banks are the First Bank, UBA, Zenith. Those are the tier 1 banks. This is a tier 2 bank that has got itself great subsidiaries. I particularly like the pension arm that they have. When you have exposure to a pension, a PFA in Nigeria, what you're getting is access to long-term financing, because what happens is that you're able to buy bonds because the pension funds are the largest holders of long-term investments in Nigeria. So in terms of the investment banking, getting access to that particular market of the Nigerian sector, not a lot of banks have access to pensions, not a lot of banks, just a few, and FCMB is one of them. UK, the credit direct that they have, they're using AI to do credit decision, so they can do a credit decision in very quick time, 24 hours or 48 hours. They can tell you yes or no. Lots of folks use credit direct. If you work for the public sector, you know what that is. So it's a very small, so we say nuclear reactor bank. They've got lots of power packed in this small capsule, that if they then get more capital and are able to then play at that bigger league, they already have the attributes that the quote-unquote big boys have. So it should be very interesting to see this bank then move into that cadre and say we want to compete with these larger banks, but with our own attributes of the pension, of the credit direct, and our IT base. That's just my take on the Bank Olumide. So if you want to say something, we'll take it, and we'll take the questions from the floor now.
Yeah. So I was reading the questions on below the space line. And I realized that some people don't understand that 50 kobo narration. So most stocks in Nigerian stock markets are listed with what we call nominal value or per value. So it means in retrospect that it cannot go lower than that price. So it's not a number you should just it's not something you should consider when you see it. It's just the numerical of just analyzing that common stock. Another thing is that, just like Carl rightly said, you need to also factor in macro conditions. You see, I get in a lot of comments on why bank stocks like this, why bank stocks like that, why my father invested this, my father invested in that, I lost a lot of money, I did this. So, just like you look at the chart, and just like you've seen, there are three things you need to observe and take into consideration. First, Nigerians' richest men are heavily invested in the stock market. So how are they immune to this currency risk, the economic volatility, and geopolitical uncertainty? It's simple. You need to understand the market fundamental cycle of the stock and the exchange. Nigerian stock market is not the US stock market where you hold like your life partner. I've always said it that if you treat me or Kalu the same way, you might get into trouble, because Kalu is calmer than I am. Kalu, you might troll him, he will not block you. You troll me, I block you. You know, you treat an American woman the same way you treat a Nigerian woman, you get into trouble. So you need to understand the characteristics, and that is where knowledge, that is the defining part of knowledge. So you might listen to all the things Kalu and I have said and still lose a lot of money if you don't take the investment advice from your bank, your investment bank, for additional guidance, and also understand the market you are involved in. So you need to also look at the fact that currency risk is an issue, because it's not common sense for you to hold on non-denominated asset blindly when for too long, when you can really position yourself on getting in and getting out. So people say, then is it not trading? No, it's not trading. When you are investing, you must have an objective. And that's why I said that it's very, very important for you to meet an investment bank, for you to design your portfolio. You must understand your horizon. What is your investment? If you look at FCMB now, I own part of the stock partly because of passive. The dividend yield is not as high as what I get from Zen UPA, but it gives me that edge because it grows faster than those two banks. So it's something that can be your pool, but you need to understand the downward risk of the price you are entering. How bad can it get? What's your long term? So these are issues you need to really sort out. Then finally, currency risk. You know, I mentioned, you see the dancing of the naira. You see how the naira danced this year. different pundits have gotten it wrong, all because oil production is steepy. So while you're investing in the Nigerian stock market, you also need to understand that the currency risk can be a problem. But there are a lot of smart people that I know, particularly investment bankers. What they do is that, so every stock has a ceiling. You need to understand how to read a stock. So look at the chart now, look at FCMB, look at when the stock was 10 naira, how did it behave? Look at when the stock was 8 naira, how did it react? Look at when the stock was 6 naira, how did it react? You need to understand the fundament. So if you don't have that technicality or the knowledge to go to do that research, then your investment bank is your best bet. Why I'm saying all these things is that you need to be aware of the risk, and it's not just, you read the analysis, the metrics, and jump in and buy. A lot of people lose money because they think investing is just holding, buying at low value and holding. It doesn't work in Nigeria. Nigeria is a different market. The market is growing, but it has a lot of unique risk, which I wanted to highlight. Carl, thank you.
Yeah, thanks, Nomde. Yeah, thanks. And the last one, probably like to get Oxley in here to speak. If you want to participate in any public offer, right, the best way is to go through your bank or your stockbroker. Most banks have stockbrokers. Most stockbrokers are standalone. If you deal with the like the online apps, check if they do offer a way for you to buy the stocks by clicking the button. You have to fill out a form to buy a public offer. Remember, you have to do an application. It's an offer for subscription. So you've got to apply to the registrar or to that company that you want to buy their shares. So I would say go to your bank, go to your stockbroker, fill out the form. Make sure you select the electronic or the digital dividends option, so that you give them your bank account now. So when they want to pay you dividends, they pay your dividends directly to your bank account. They are not sending you paper dividends. It's also best practice for you to have a separate account where you are getting your dividends separate from your normal bank account. The idea is that you want to do reinvestment of your dividends. Most in the West, they do have what we call DRIP, dividend reinvestment plans, where you can tell the company, hey, I would like you to use my dividends to buy me more stocks of this company I bought, right? Because if you do that, what you are achieving is a reduction in your average price. So look at it this way. If I buy FCMB, for instance, at 7 naira 30 kobo, right? If next year FCMB pays me 30 kobo dividends, if I take that 30 kobo and I buy more stocks, my average cost is coming down. If I keep on reinvesting my dividends to buy more and more and more and more stocks, what I'm doing is that I'm getting more equity with less cost. Mathematically, my average cost is coming down. So that even when the share price comes down, overall, I haven't really have a realized loss because I've reduced my average cost by reinvesting my dividends. So if you have a separate account where you keep your dividend, not just for this particular bank, for all your equity that you buy, it's easier for you to track those dividends and then use them to reinvest, or you can buy something else, but have a place where you can separate and say, these are my cash dividends I've gotten from my equities, and I want to then do this or do that with them. I always am an advocate for you to reinvest your dividends. Again, if you want to compare a stock to property to bonds, you've got to look at the yield. Not the price, not the movement in price, the yield. So if you take $1 million and you buy a property, or you take $1 million and you buy a bond, or you take $1 million and you buy equities, which one would pay you more? I.e., which one will give you more yield? You've got to look at the yield, which means you're going to take your cost, you're going to take what you are making divided by the cost of you buying it. So if you look at the dividend yields for the bank, or for the Nigerian stock market as a whole, you compare that to real estate yield, you compare that to, say, bond yield. That's how you are comparing yield to yield. Don't compare the property went up in price. That is price movement. What are you getting back? What is your tenant paying you from that property? That is yield. Same way with the bank. You're not going to say the bank share went up by 12%. No, what are you getting back from the bank? That's if you are a holder. If you're a trader, of course, you are buying and selling, you are making your return. But if you're trying to buy to hold, you are looking at your yield. Olumide, we've talked too much. Let's get some few guys in here. I see a lot of DM questions, but let me get Oxley has been waiting here with his hands up. Oxley Tech, you've got a question on the FCMB and general public offer. It doesn't have to be FCMB. In investment questions in general, please go ahead and ask. If you have a question, also request to speak. We'll put you up. You can ask your question, and we're good. Oxley, you've got the floor. Go ahead.
Yes, hello. Hello, Carlo.
How are you? I can hear you, sir. Please go ahead.
So I have two questions, but before I ask my question, so I just want to draw a parallel. FCMB is a very good bank. From little I know about them, I used to have a friend that worked in their credit direct. They have a credible database of creditors in Nigeria. I think they are one of those people that spearheaded or pioneered the credit bureau stuff, in Nigeria. So it's a very good place to invest. But I draw a parallel with FCMB with Fidelity Bank. So they have in terms of they are tier 2 banks, almost at the edge of, two of them are almost at the edge of crossing into tier 1, but they are not doing badly. Fidelity has just closed their offer recently, and I heard that they were oversubscribed. Yes, I took advantage of that. So, and I'm looking forward to, learning more about FCMB and how it's going to make sense to me as a personal level. Now, the question I have is this. Number one is, given that most of the banks are coming to the market at the same time, almost all the tier 1 banks have gone to the market. Some of them are there, so I don't think anybody I think it's only Fidelity that have closed their platform for subscription. So almost all the banks are in the market. Now, what does this? I want to limit it to give us a sense of what is the risk of almost all the banks coming to the market to jostle or hustle for limited funds. Now, those limited funds, people are keeping savings, people are keeping their deposit in the bank and trying to make a decision of whether should I use my savings to go purchase, shares. Now, there's also a risk of people trying to take a facility, a loan, or what they call the margin loans. And when I hear margin loans, it brings my head to 2007, 2008, 2009. So people now going to the banks or going to creditors to say, hey, give me a loan, and they use that loan to buy shares. Some of them may take the loan for something else. They can disclose something else as the purpose of the loan, but once the credit comes into the account, they are going to the capital market. So what is this risk that you see, Olumide and Carlo, of almost all the banks coming to the market at the same time, jostling for limited capital, limited deposits or savings of people, and the risk of the capital market getting exposed to facilities, loans, and what is the prospect for repayment of those loans? Because of course you are taking a loan to buy shares. The shares might lose value in the short term. Maybe there are long-term prospects, but you might lose value. So how do you repay the loan? Also talk about the dynamics. That's question one. Question two is I've seen some the groups in the banks, operating what they call a non-operating holding company. A few of them that come to my mind. I don't know whether FCMB is part of them, but I know of FSDH. I don't know whether Access is non-operating. What is the dynamics of operating a non-operating holdco structure, and what does it? And in terms of just explain it vis-a-vis, somebody that wants to invest in such organization and how it plays out. Who is the owner of the shares? For a company that has a non-operating holdco, is it the bank that owns the shares that is in the stock market, in the capital market, or is it the holding company? So I just want that non-operating holding company. I just want you to, throw more light on that. Thank you.
Okay. I'll answer the first question. I'll give the second question, Carl. So the first question was that the risk that banks raising so much amount of money in a market that seems to be quite illegal in terms of the big disposable income they have in Nigeria. The risk was not so high until the federal government came in, and I'll explain why. So, investment bankers did their job, and you look at banks, the position we entered, you could see that some banks have not come in, like UBA and First Bank. These are big banks in their own right. And if you look at the price action for the banking index this year, they are suffered, and the reasons why they are suffered, two major reasons. First, we are in a very tough economic environment where banks have a high CR, and the CBN is also hampering aggressively on them. Then you also look at the fact that the recent windfall tax had a dent. Then there was a big cloud. If you look at some days ago, Kali tweeted a beautiful chart where he told to comment on the fact that a lot of foreign players were not investing in our market. Why was the reason? So we have downgrades from major rating firms that evaluate stock position, which ETF plays the key role. That also had a negative impact. So with all those concerns, banks were still looking good. But the windfall tax was a kick below the belt. And that was because the federal government's excuse was that other sectors were not viable in terms of profitability, and it seems banks were doing so much. Now, what it means is that it might be tough, but I see most banks still scaling through. And the reason is not far-fetched because Nigerian banks have one of the best capital networks in Africa after the South Africans and Egyptians. If you look at each bank, from the likes of Elumelu, Movia, Pola, Jola, Shego, and Badi, you will see that they are not just professionals. They have they have the skill to network different market players, and you could see that even a bank like Jaiz was getting liquidity at ease with foreign partners. So that was not really the concern of investors. The concern we have in long term is the federal government, like I said, because it seems that we are in a country where the most efficient and the most profitable people seem to be punished. Now, the excuse is that why are banks so profitable? Banks should not be profitable. People have forgotten that banks are already switching away from their duties. It's not their fault, but you could talk about that. So if you look at FCMB, for example, FCMB's FX gains were very high. In fact, I wasn't surprised when the group MD and Tony Lubin went to go and see President Suku after the windfall tax issue. And because if you look at the Q1 result, their foreign exchange gains was 1,359% yet to be. So it just tells you that the banks have been able to bring themselves against local uncertainty. So investors do have a problem with that. So if you look at Zenith, for example, the stellar result they just brought out, you could see that banks look solid. The key here is that investors right now are not sure that the federal government will not bring anything funny. So if you look at the mood around banks, they've been able to recover from their dips, the dips in April, but they have not reached the high of this year. And that's where we still need to look because we still have 4 months to go this year. So, there's still time. But I think, to be honest, it's not something that banks are really worried about because naturally they know that a lot of Nigerians don't invest. A lot of Nigerians don't keep $5 in the bank account. They know their target audience. They know what the strategy is. But the question mark is that some banks will definitely suffer, let's be honest. Some banks, especially those with weaker FX network or people that don't have starmen in their board. So I think for FCMB, I think the way it looks like the amount and the way they position themselves, it shouldn't be much of a problem. However, I don't see them getting as fast as they.
Yeah, Olumide. Okay. So I think to just answer, he's saying he's asking about the holdco side and also all the banks coming to the market at the same time. The banks are the invest the let me put it this way. Companies that are publicly held are always in the market at the same time. So if you go to the Nigerian stock market, you're going to see nearly all the banks that are publicly listed. And you see the interplay of investors saying, I want to buy this bank, I want to buy that bank. The difference now is that this is a mandate. So the CBN has mandated all the banks to come to the market and raise capital, like you said, at the same time. What this means is that the investors are going to be given a choice of maybe 20 or more banks. And the banks that have a good brand name that can tell a story backed with numbers are going to win. Not every bank is going to... I suspect that all the Nigerian banks are going to get capitalized. But to what level? Some might drop a license here to get capitalization. Some might say, I no longer want to play internationally, I want to play locally, so I need a lower license. Some might say, I even want to increase my capital and go all out to become an international bank. You're going to see a changed environment in 3 years' time from today in Nigerian banking, in the Nigerian banking sector. The point is, there will be a realignment. What CBN wants is to have its quote-unquote too big to fail banks, so that it can have systematically important banks. Then it can then work with those systematically important banks and say, okay, if you want to drive FX, if you want to drive loans, we focus on this guy. Just like in the US, you have Chase, Wells Fargo, Bank of America, Citi. Those are the banks that they use to drive and push, should we say, monetary policies down the pipe. That's what CBN wants. It wants really systematically strong banks in the Nigerian sector. So many banks will be there, but will not play at a higher footprint than where they are today. All the banks, if all the banks come to the market, they'll raise capital, all of them, because Nigerians we have a lot of loose capital. And remember, if you were to plot across Nigeria today, where should you put money? Let's just say you are looking at returns and you had an inflation rate of about, say, 35%. Only the Nigerian capital market is beating inflation in Nigeria. Only the Nigerian capital market. I think about 34, 35 is our return, and we are positive, i.e., the returns on the Nigerian stock market index is beating inflation. So that already gives the banks that are on that index should we say, an advantage, because if they can make the argument that, listen, over the long term, our index has beaten inflation in Nigeria. Look at the GDP growth that just came out recently. The GDP growth in Nigeria is coming from many sectors, but particularly from banks and insurance. I think they're growing about 66%, banks and insurance. So those guys are growing. They are making a lot of profit. How they're making the profit is a different topic entirely. But Nigerian banks have got the best Nigerians working for them. You can argue, but their treasury teams, their investment teams are the best of the Nigerian workforce in Nigeria. So they've got the best guys that can go to the market and can do trades and can do deals. So this dovetails to your second question of, are you buying the group? Are you buying the holdco? Are you buying the bank? Look at it this way. If I buy FCMB group, I am buying with 1 naira. I am buying the bank. I'm buying the PFA. I'm buying the bank in the UK. I'm buying Credit Direct. I'm buying the stockbrokers. The CSL. I don't know if you can take your time to Google CSL stockbrokers. Those are massive players. Those guys are massive. They are plugged into the Nigerian stock market. Those guys. So you are buying the FCMB bank group. Yeah, you're getting exposure to all these subsidiaries. There are very few banks you can find in Nigeria, tier 1, tier 2, that have this spread of long-term PFA, short-term stock trading, trustees, bank. Very, very few banks you can have that spread. So what it means is that for a consumer, as we start to go towards a fragmented, or should we say a consolidated banking environment, a customer of FCMB can stay in that FCMB ecosystem and do a lot of things. If an American bank were to come to Nigeria, who would they look at? They look at a bank that they can push their products through from just one source. So if you have like a bank that's got lots of subsidiaries, it's easier for you to get across the different strata than if you're just going with a bank that is just big by way of asset base or capital base. So a lot of advantages by having this holdco structure. And for you as the investor, imagine, like I said, with 1 naira, you are getting exposure to all these companies. than saying you're going to go buy the bank and then go buy an insurance company, then go buy a PFA. So in a way, it gives you that spread. It's like you're buying exposure to the Nigerian economy from just buying a holdco that owns a bank. That's how I look at it, and I think it's only going to be positive going forward. Banks in Nigeria always make money. And when I mean always, I'm being figurative, but they always seem to find a way to make money. People don't like it because people say the real economy is not doing well, but banks are making money. But if you hear that as an investor, what does that tell you? That tells you that, okay, I can have exposure to Nigeria by owning a Nigerian bank. And I can sit there and wait for the economy to sort of open up, and then I can get into it. The last thing you asked, you made a statement, but you didn't ask the question on Oxley Tech. You are talking about margin loans, people borrowing money to buy stocks. I don't advise you borrow money to buy into a variable return product, because when you borrow money, your costs are fixed, but the return from the stock market, even though they pay a dividend, the stock price goes up and down. Your margin is based on the price movement, not on the dividends. So if you have money you can invest for more than 1 year, the stock market is calling you. If you want to borrow money for very, very short periods where you say, oh, I want to go in and I want to come out and I've protected my exit and entry points, then you can borrow money. I give you a story. I've given this story a long time before. When credit cards came out in Nigeria, I used to work in an investment bank in Lagos. We were one of the first guys. They came to us and offered us credit cards. We earned a lot. They gave us credit cards. Do what we do with those credit cards? We were buying stocks, public offers with our credit cards. And the deal is this: when you buy a Nigerian company during the public offer, the share price goes up. Or when you buy a company before bonus, the share price goes up before the bonus. If you can get your bonus shares, take it to CSC. This was way back, not now, way back. If you can get your bonus shares and then take your bonus shares to the CSCS, get into the market and sell, you make a lot of money. So it's a timing thing. You borrow money from the credit card company, you buy the stock goes up in price because of the bonus. When the stock price falls because the bonus has been issued, Nigerians look at the price and say, wow, this stock is now cheap. It's the same thing. Psychologically, they think because the price has been cut in half because they gave a 1-for-1 bonus, that the stock has fallen in price, hence they want to buy. It's wrong. That's a wrong approach because the stock price has not fallen. It has just been adjusted for a bonus. So they rush and they buy. That rush to buy is your profit. So if you know how to use a credit card, you can get in, get out, pay by the credit card company before 30 days and move on. But I can assure you, in that same transaction, we got bonds because they now changed the rules and we couldn't get that share price bonus and we got bonds. So be very careful about borrowing money to invest in an asset that has a variable return. You could get caught up before you are out and you could lose all your profit.
Can I just add some slight into it? And so for people that really want to invest in other markets, definitely the Nigerian stock market is the easiest place to start with, particularly for those that have lower disposable income. And I'll tell you why. I often say with 1,000 naira, you can buy all types of listed bank stocks. I think the most expensive bank stock is GT, which is not even up to 15 naira. So it just tells you that it's a place for learning. It also gives you the ability to understand how stocks react. Because you see, if you can't react to naira exposure, how do you start dollar exposure? And it also gives you that intellectual capability to read statements, because these companies are listed, they are heavily regulated, and they are compliant, so regulatory compliant, so they have to release results, unlike private entities. And Carlos said something that I want to really highlight. Nigerian banks, despite the fact that people say that their customer service performance has moderated heavily, they still have the best professionals by far in the industry. In fact, I remember 5 years ago, my colleagues, I was making a bet. I said that Nigerian banks, fintechs, I would bet with Nigerian banks. And they were like, oh, no, it seems I'm old school. And they were looking at technology. And the reason wasn't far-fetched. You see, if you look at the setting of Nigerian banks, despite their excesses, they don't joke with compliance. They don't joke with risk. And also, if you look at capital efficiency, the fact you see a fintech founder spending $20,000 when the company is not even making 1,000, you rarely see those things. So yeah, you could argue that some bank entities have private jet and things, but if you look at capital utilization, you don't joke with banks. So it's a place that you can really start your onions for those that really want to be kingpins in investing. And those that are skeptical about investing, yes, the risk with Nigerian banks is that they don't grow like what you see in Orlando. You rarely see a Nigerian bank now saying you do 20x. No, that's not a mini asset. So if you're looking for a mini asset, Nigerian banks are not for you. But you also don't see Nigerian banks dropping 97% of its value. It really happens. It really happens. So you need to evaluate why people hold this stock and why is it good for you. So if you know that you're young and you really want to learn, then stock investing looks like a better reach with the guidance of sophisticated tools. Now there are so many tools you could use. It talks about results. I post different trends about companies. There are different news sites. You could also, your investment bank, they have excessive tools. I don't know why people don't read. Most of the information I get, apart from price action, are from my investment bankers. So you could also tap into those things. Then lastly, it gives you one important thing that is lacking on social media, the ability to discern. So for example, now, if you look at the performance of investment in different markets, you see that those that had some Nigerian exposure are not doing bad at all. So what I'm saying is that as long as you're Nigerian, as long as you spend Naira, as long as you have Naira obligation, you definitely need income from that side, one or the other. Because yeah, you could, even those that earn $10,000, there are times that the pays to liquidate, pays to access different might be tough, and you also need to look at tax obligation, because a lot of people they forget that in those markets, capital gains are they don't come cheap. In Nigeria, any investment less than 100 million naira, trust me, you don't get capital gains on it. So you need to look at the opportunities that come in from each side: tax advantages, hedging, positioning, growth potential, and you merge it. Nobody's saying the market, Nigerian market, is the best place to invest. We also, we highlighted currency risk, but it's a good place to start going from. A child, you don't start a child with a laptop. You start a child with a sheet of paper or slate. So that as child grows, you now buy more expensive materials. Except even if you are a brigade, you have to ensure that you start from the basics. You understand the basics. And one of the problems people have investing in stocks is that they don't understand the basics. Carlo have been saying this things for many years. And I think everything has been said. But the most important thing is that you must have the ability to sell. There's a lot of information out there, that makes people crowded around investing. Investing, definitely you lose money. I've lost so much money, but I can tell you for free that I started from Nigerian stocks, and I have invested in 12 different markets around the world. I write in different markets around the world, and it has helped me. So if you really think that it's a place you want to learn, I think stock, particularly bank stocks, like I mentioned, highly liquid, value, the risk downside.
Sorry, I muted him. Go ahead.
Yeah, so the downsides are not as high as you see. So you might not get the 20x you're looking at like you get in Shiba Inu, Ethereum, or Solana, but the reality is that it positions your intellectual capacity in investing in mature markets. Because see, the top 500 richest people in this world are not, apart from CZ. Okay, so CZ is the only top person of Binance. It's the only billionaire on that list that most of his exposure is in crypto. Even at that, it's because of his in Binance. So you need to look at the importance of equity investing, that equity plays a major role in income generation. You can't compare with other markets like PSD and things like that, but it's a good place to go. So please take this space. So I think.
All right, Lumde, thanks for that. Let me get. He's been waiting. Sapien, how you doing? Thanks for holding. Sapien, is it Sapien? Okay, Lumde, I wanted to just add real quick, right? If you are interested in this offer, any particular offer, like I said, go onto the app, go to the FCMB Bank app. It's there. Go to your ask your stockbroker. They would give you guidance to buy that. Go to your bank as well. Most of them are receiving agents, so it's easy for you to buy shares. If you live in Nigeria, I want to give a broad financial advice. You have to be exposed to the capital markets in Nigeria. This is vis-a-vis how old you are. If you're a younger person, I would like you to open a stockbroking account and start to put even a tiny percentage of your funds in Nigerian stocks. I think it was 2 years ago, I believe, 2 years now, I think in 2022, the Nigerian stock market was the best performing stock market in the entire world. This is a growing economy. It's something you want to get exposure to. Don't put a lot if you don't like the risk, but have exposure to the market. Dr. San, you've got the floor. Go ahead. What's your question?
Hello?
Yes, hi. Go ahead. I can hear you. Dr. San, you've got the floor. Go ahead. All right. I will remove him. Kendall West, I'm not sure if you're a real person or if you're... I'm not really sure if you want to speak also. Saipem, I will take you off the space. I request for you to speak, but I've not heard you speak. Olimde, again, let me come to you again. DM question. Someone is asking, what is a tier 2 bank and a tier 1 bank? Is it a capital requirement? Is it number of branches? What makes one bank tier 1? What makes one bank tier 2?
The capital, sir.
Kendo, are you speaking or?
Yeah, capital.
All right. Let me just take off Kendo. I've taken him off the space completely. Yeah. So Lumde, what's your guidance on that? Is it more of the capital? Is it a branch network or capital? What makes a branch tier 1 or tier 2?
All of the above, Carlo. All of the above. I can't just remember the actual figure. So usually the reach of the bank, there are different types of license. Some banks are allowed to operate nationally. Some banks are allowed to operate regionally. Some banks are allowed to operate internationally. So the tier 1 usually we call universal license. So you see banks like UPA. So we have 5 officially. But the tricky part is that if you look at Fidelity, some people tell you that it's tier 1 by principle, but it looks like they're raising money towards that side, and that's because they already have an international banking license. So it's something you also need to look at. Then you look at banks like that have international exposure, but they build their subsidiary nationally. Big to play. So if you look at it, for example, one of the biggest banks in Africa is Standard Bank. But rather than Stanbic having a universal, they focused on the local Nigerian market. So you see that it has a national. So raising capital for the bank is not the raising requirements is not as high as what we see in the Access or UPA. And I think we look at the fact that that bank also has a strong investment network in Nigeria and pension management. That's why the bank is even the most valuable tier 2 bank. I think it's around 731 billion. Then also look at EcoBank, ETI, the same principle with. So definitely it plays a key role. But like on this space, we mentioned the advantage of tier 1, tier 2. So you look at it, for example, in JP Morgan, the biggest bank in America, most valuable bank in America, with that sizable amount of market valuation, it's very unlikely for you to do a 2x within 2 years because, just like Carlos said, established banks grow slower, because you look at a lot of things that they're reaching their saturation stage. But unlike tier 2 banks, the banks, they have room to grow. So investors usually that are in tier 2 are more on the mixed side of growth and conservative. When I mean growth, people that can take risk and look at growth potential rather than just passive income, So you need to look at your investment horizon and perspective before putting exposure down. Like I hope I was as
Yeah, and I can give the CBN number. So if you want to get a commercial banking license in Nigeria to do international, CBN wants 500 billion capital from you. If you want to get a commercial license to do just the national, 200 billion. If you want to do commercial regional, 50 billion. If it's a merchant bank to do national, 50 billion. Non-interest banking to do national, 20 billion. Non-interest banking to do regional, 10 billion. So the cheapest license in Nigeria is to get a non-interest banking license to be only a regional player. That would cost you capital of about 10 billion. The most expensive is going to be a commercial international bank. You can do import export for 500 billion naira only. Let's get Johanna Mustafa. Johanna, how you doing? Joanne, hi, how you doing? Okay, Joanne can hear me. Let me get Victor. Victor, what's up?
Yeah, hi, Carlo. Good evening.
Yeah, go for it, sir.
Yeah, very well, thank you.
Johanna, hi. If you're muted, you can speak and I can put Victor on pause. Johanna, ready?
Yeah, I don't know if you can hear me now.
I can.
All right, great. Great to be here, and obviously an amazing conversation. And, both of the speakers, you and Olumide, speak extensively on bank stocks. So again, as a new investor, bank stocks so far has been a major drag on my portfolios. So, but from what I'm hearing here, you can only get the most out of bank stocks if you're holding long term. Like, can you provide more perspective on that, especially as opposed to if you're looking to trade on the stocks, take profits, from time to time on share price appreciation. So, is there a hack to benefit the most from bank stocks, or the best way to get the most out of them is if you're holding long term?
Not really. All stocks, right? If you want to trade, you're looking at the volume, because the volume movements drive the price movements. So it doesn't matter what I buy. If I buy an underpriced stock, which means somehow I've calculated value to be 10 naira. If I know value is 10 naira, then I want to buy that stock below 10 naira. And then simply wait for the market to get to 10 naira and sell. So if you are trading, you are trying to buy a good stock at a lower price. That's trading. When you make the profit in trading is when you buy, not when you sell. When you buy at the right price, then you can sell and make a margin. Most times people are buying the good stock, right? But they're buying at an expensive price. That's what's going on. So that's how you want to trade. If you want to buy to hold, it can be the exact same thing. You can buy the stock and simply hold it and reinvest your dividends for the long term. In which case you are looking at the fundamentals. You are saying long term, this stock will grow faster than inflation for me. So my delaying my consumption today is going to pay me in 5 years, 10 years, that the stock price would have grown faster than inflation. But trading is much more, you need more tools to trade. You need to know what is a good, if you want to get a good way to hack it, right? When you pick the stock, what's the price today? We're talking technicals now. What's the price today? What's the 52-week high, 52-week low? So the price you're looking at, where is it? Is it near its high? Is it near its low? Is there any announcement going to happen? Is it near its annual general meeting? Is it far from its annual general meeting? Those two questions tell you if it's a good entry price or if it's a bad entry price. If you're buying a stock near its AGM or near any major announcement, I would hazard a guess that you're already buying that stock with its profits already built in. So you're already buying from someone that bought well before and is selling to you to make the profit. So you know what I said, when you buy is when you make the profit. If you buy Messi today, you're going to make a loss because Messi is already an advanced product. Where would you sell Messi to? Who would buy Messi today? But if you bought Messi when it was in Argentina 15 years ago, you make a lot of profit. So the problem is not Messi, it's when you are buying and at what price you are buying. So you want to buy Messi when he's young, before anybody knows him, and before Barcelona announces they're going to buy him. If you buy him when Barcelona announces they're going to buy him, you are buying the Barcelona announcement. It's going to be added to your price. So you are buying him overinflated. So it's difficult to make money because you already bought him at a high price. But if you buy him at a lower price, then you can say, wow, I bought a player no one knows about. When he goes to play for Barcelona, the first match, then you make a lot of money. Hope that makes sense.
Great. Yes. Thanks, Carl.
And let me just add to what Carlo said. So if you look at the market cycle of the stock market, for example, a lot of people make the mistake of buying at the peak. And people ask, how do you know the peak? So market cycle, there are different stages of, just like when a woman is pregnant, at the first 3 months, you know that it might not be visible. At the second stage, you see visibility and you see strain. The last, it also happens in the stock market. So the problem is that most times people buy at the peak because that's where the excitement is. So if you look at Orlando, for example, I'll just give you an example. Look at Orlando, for example. People were not really interested in the stock because this was a stock that was ridden with debt, stock that had governance issue. That's by the fact that the nephew of the founder, the CEO, had a strong decision. It was the nephew to the president. Well, if you look at the accumulation phase, you see that right now it seems that it's at the peak now. So, but that's where the noise is, because when the stock is running, that's where you get the excitement. So you need to understand the stage you're investing. And it's very important because, you see, for those that are investing at the peak, heavy drawdowns can pose a risk on your portfolio. So a lot of people bought bank stocks early this year on the run that many banks did stellar results. It wasn't that banks were not doing well, and it wasn't that banks had peaked. But you need to be aware that the position, the price they were in, and the position they were, any back or misfire from the ruling class or regulatory body could spell doom, and that's why you saw some of these banks moving down. But having said that, it's so very, very key that before you invest in a particular stock, understand the power of numbers. 1,000 naira is different from 500 naira. 500 is different from 100. If you look at each bank stock, they have their psychological levels. So a smart investor, before you go into the stock, after looking at the financials, you look at the result, look at this Carlo said, the timing, look at the price you're trading, the stock is trading. Look at how it has reacted and how long it has stayed in that position. Then look at the worst level it has been in the past 2-3 years. Then weighing your downside, you have to be able to accept that you must be willing to take in losses. A lot of people don't take in losses when they should. And one of the advantages Nigerian stocks have is that there is a maximum percentage it can fall a day, 10%. Also, there's a maximum amount it can rise. So it gives you the time to really adjust your positioning if you really know how to work it through. So it's very important for you guys to know the power of numbers, the market cycle,
and the fundamentals Carlo highlighted. Thank you.
And Yana, just the last one for you, right? Just the last one for you. There's events and there's earnings. Events and earnings. When you're a trader, events move you. So what is an event? School fees. When do kids go back to school? That month they go back to school, their dad has to sell a few shares to make money. Or Christmas, people want cash. So that's events. It moves traders. Earnings move long-term investors. So you are concerned about earnings, so you don't care about if the stock price went down in price today. You look at are they investing in a new factory today that will give them earnings tomorrow? Look at Dangote. Dangote was building new cement factories whilst the other cement companies were looking. And Dangote went from zero capacity for cement to the largest manufacturer and exporter of cement in Nigeria in less than a decade. There is no other country on earth where a new player will be allowed to come into a market and dominate the market. No other country. Same with banks. You had Standard Bank that was owned by an individual, and Standard Bank bought UBA. Look at Zenith Bank today. Look at Access Bank. As a matter of fact, the top three banks, Access, Zenith, UBA, these are all, when I mean UBA, I mean it was really Standard Bank. These were quote-unquote civilians, first-time bank boys that came in and took over the banking sector. It can't happen in another country where a new player will come in, for instance, and knock off JP Morgan Chase. It's not going to happen. Why? Because earnings, you invest back in your earnings, you look at the earnings growth, and then you invest, right? Let me use football terms. Many people are listening, they don't understand. Let's look at football terms. If you pull up Manchester City and Manchester United, who is more successful on the football pitch? It's of course currently it's Manchester City. So they've won the last four, right? Manchester City's valuation is 4.99 billion. Their revenues are 815 million. This is from Forbes. But Manchester United has got a larger valuation than Manchester City. Why? Because it's Man U. They've been around longer. They have a longer brand name. They have goodwill. They have all these intangibles going for them that Manchester City, even though they are winning today, cannot get. They have to be around for like 10 years for the Manchester City brand to be like the Manchester United brand. So even though City is winning more trophies, winning more earnings, the market is still saying that Manchester United is a bigger club because the market is rewarding Man U for what they already have on ground. Goes back to the point I made at the very beginning. You want to ask, is it a growth company or a value company? Growth meaning that if they get money, will they invest in new things and grow? Or if they get money today, are they going to invest in established things? So if you look at Man U, for instance, they already have Old Trafford. They're not going to build a new Old Trafford. But look at Man City. Man City just won their first Champions League, right? They are going to grow based on what they do. But Man U is already established. It's already a brand name. So if you give Man U money today, they're not interested. If they don't win a new Champions League, it doesn't diminish the club, right? But if you give Man City a new Champions League, it makes the club bigger. That's why Man United's cap is bigger than Man City's cap. So if you change those Man City, and make it two banks, you make it an FCMB, and you make it, say, a Zenith Bank, you have to ask the same question. If you give 1 naira to Zenith Bank and 1 naira to FCMB, where would it have more value? Where is the market placing the growth? Where would there be more earnings? Is it going to be at this lower bank stock, or is it going to be at this higher cap bank stock? That's what you want to ask yourself. If you can get that answer right, then you make a lot of money. Let's get Victor. Victor, you've got the floor. John, thanks a lot for your questions. Victor, you've got the floor. Victor has dropped off. Let's get, what's his name? Godia? Did I get that right? Godia?
Yes, this is Godia. Good evening.
How you doing? Welcome.
Fine, thank you. So my appreciation to the host for hosting this space. So I'm new at investing in public offers. So my question is regarding shares certificates. So I would like to know, because I bought my shares using the apps, the bank apps and the apps for the shares. So I want to know, after using the app to buy the shares and it's successful, do I need to have share certificates for the stock to be valid? That's my question.
Wonderful question. Thanks for asking that question. Really, thank you. So usually in the past, right, when we buy a stock, we have to get the share certificate. Then you take the share certificate. If you want to sell it to your broker would do what they call dematerialize. So they take that certificate and they make it electronic. That allows you to trade. Holding the certificate is enough. If you hold the certificate, it's still valid. So Nigeria has moved to an electronic custodian service. So you see what they call CSCS. I'm not sure if you saw that on the app that you used. They'll tell you to get a CSCS number. What that means is that your physical certificate will be taken and turned into a digital certificate. That allows you to trade it faster. It doesn't mean if you hold the paper certificate, it's illegal. So most of you have got parents that bought shares a long time ago. Like my granddad had shares for Nigerian Tobacco Company, First Bank, Standard Bank. He still had a share certificate. Those things are still valid. You take them back to the registrar. You want to find out who the registrar is, take it back there. They would dematerialize it for you, make it like electronic, and it goes into your CSCS. It's when it's in your CSCS you can sell. So to your question, if you bought the share through your app, just having it, the app would do your CSCS automatically for you. Like the guys that bought MTN, most of them got electronic CSCS automatically. But even if you don't, if you get the physical paper, it's still valid. It's only when you want to trade that you have to dematerialize, make it CSCS to then allow you to transfer from yourself to somebody else. So any which way, if you're buying for long term and you want to hold a certificate, fine. If you want to dematerialize CSCS, fine. What is I always advise is to make sure you do the electronic dividends, right? So that way you can get your dividends paid directly to your bank. Does that answer your question?
Yes, it does. Thank you very much.
Brilliant.
Yeah, Carlos, yes, sorry, I wanted to add, I saw some questions, particularly to what Lily asked, relationship to opening stock account. So, Nigerians, there are a lot of stockbrokers. In fact, regulated stockbrokers, I think we have more than 60. But we have titans, we have the ones that are attracted to tech savvy. So, depending on what you are looking at. So if you look at the biggest stockbrokers in Nigeria, particularly, it's usually around Cardinal Stone, Stanbic, APT Securities. You see the Chapel, CSL, and co. But you see, the problem with them is that they deal with heavyweights. So their customer care service might not be like what you expect. Now, if you look at stockbrokers that on the tech side, Bamboo, RiseVerse, Chaka, different that you see all around there, you get the opportunity to even trade foreign stocks. But the catch is that you might not get the kind of service you get with those big boys. So the reason why I'm mentioning is that a lot of people usually ask, what stockbroking account should I use? You check reviews. You check what you're looking at. Like I mentioned earlier, if you're a big giveaway, for example, if you know you want to trade more than 5 million upward and you want fast check the access to the market, definitely the big players. If you want to have diversified investment opportunities, definitely the tech guys I mentioned. So wherever fits your horizon, ensure you check reviews. Because the reason I'm saying this is that I also have horrible experiences trying to open a stockbroking account with some brokers. Some will even ask you to bring your foreign nationality. You'll not be wondering, but this is, I've sent you my, I'm just giving you an example how cumbersome some processes are, and some directly. But the most important thing is that you must deal with a SEC regulated, is the most important thing. It's better not to invest than to invest your money with a broker that does not have Security Exchange Commission. Because the painful thing about it is that, yes, your investments are not insured, but there's what we call the CSCS or clearing number, where even if a stockbroking firm goes bankrupt, your investment is still on the system. All you just need to do is to ask for, you check your CSCS number. Normally, all those stockbrokers, when you buy a stock, you see it on your emails or transaction, and you just switch. So you can switch. So it's very important when you're opening an account, ask for your CSCS account number. If you don't have, ask your broker. It's mandated that you have a CSS. So I wanted to bring that, Carl. Thank you.
Yeah, perfect. Yeah, very important. So you have to go through a regulated broker. If you go to the Nigerian, what's it called? The SEC. At SEC, let me if you can post that at SEC handle at SEC, right? It will give you a list of brokers, list of asset managers. You are buying a commodity. When I mean commodity, you want to buy a stock, whether it's FCMB, whether it's Dangote, you want to buy the stock, right? Anyone can buy the stock for you. So I always tell people, go with customer service. Like I said, go with customer service. Who treats you better? Because you can buy your stock through any method, through your broker, through your online broker. So try to go with customer service. Who will treat you well? If, for instance, you like margin, who will give you margins? Who will file your paperwork better for you? Because it's the same thing you are buying, right? So you want to make sure that you go where you are valued. The apps like the ones that are rated by SEC are, I think it's Shaka, I think it's Bamboo, I think it's also Cowrywise. I'm not just sure those guys do public offers. If anybody knows, just let me know if you can buy public offers through those guys. But those are the ones that are regulated by SEC, i.e. online platforms. But most of your stockbrokers, most of them, Meristem, Arthur Stevens, CSL, AfriInvest, all of those guys always have robust online platforms. Like my broker, I can go online, I can buy shares, I don't have to talk to anybody. So I know what I'm doing, I can go in and buy. But if I want to talk to somebody, I send an email, they respond to me, they send me quarterly report. That's what you want to focus on. What makes your life better for you, right? Because it's a commodity, you're buying the same thing, just going to buy it through others. But remember, with the public offer, you are buying directly from the bank, just through those agents. So somebody's asking me, why can't I buy on the floor? If you buy on the floor, you pay duty, you pay commissions. Don't forget that you're going to pay broker commission and all that, because you are buying on the floor. You're not buying from the bank. You are buying from another investor. So if you want to support the company, if a bank comes to the market and you want to support the bank, you buy directly from the bank. When I mean directly from the bank, you buy the public offer or the rights offer, but you're buying what the bank is selling to you. If you buy from the floor, you are simply exchanging money with a third party. It doesn't go to the bank. So all these ideas that you see, FCMB says want to use them to do IT, want to do new branches and all that. It's only if you give them the money via the public offer. If you go to the stock exchange and you buy, they don't get it. So if you want to support them, you want to make sure you buy from them directly. Gotcha. Let's get W exclamation. W, that's at how you doing?
Good evening. Good evening. So you yourself and Olumide has mentioned a couple of things I took note of. You mentioning the fact that you should start at a young age and try and have a stock brokerage account, and Olumide also mentioning that there are several tools you could use to sort of manage your portfolio. And I won't say I'm new into investing, but I'll say I just recently became more active around last year, and I've been trying to keep a balance of my portfolio between strong stocks or public or known stocks that are like the bank stocks, like you've.
I think I lost him.
Yeah, we lost him.
It gives me an opportunity to mention. So if you take a piece of paper out, if you're a young person, right, take a piece of paper out. So if I knew what I knew now when I was 25, I would be a multi-millionaire. I'm not just simple stuff I'm going to tell you now, simple stuff. So when I was growing up, I started to invest before I got into university. I started to invest because I watched Wall Street, the movie, and that movie blew me away. I saw this guy, he was Gordon Gekko, Greed is Good. I saw that movie, it was amazing. I didn't know what they were talking about, but I just wanted to be that guy on the TV. So I started to invest before I entered university. And I did a lot of mistakes. I did a lot of good things. I bought a particular stock. The day I tried to calculate how much returns I had made on that particular stock, the calculator could not take it. I'm not exaggerating. This is based on my bonus shares they gave me. Just the bonus shares they gave me was astronomical return. But I did that self-knowledge. So let me teach you how you want to invest. Remember, now you have access to international markets. When I started to invest, I didn't have access to American markets. I just had access to only Nigerian markets. So let's do, if you're a young person and you are young, you must, the key word is must, you must invest in equities. Why do I use the word must? Because equities over the long term tend to beat inflation. So if you are 25 years old, at least 10%, I would say go more, but I don't want to give advice on the social media. I would say as much as you can, money you think you're not going to need in the next 10 years, open a stockbroking account and put it in there. So the next question I'm probably going to ask is, okay, what should I buy? So now we have what we call ETFs, exchange traded funds, ETFs. So write it down, ETF, exchange traded fund. So let's say you are living in Nigeria. Let's say you are in Kwara State. You take your phone, you can download any of these apps. You can download the Shaka app, you can download the Bamboo app, you can download the Cowrywise app. When you download that app with your Naira, you have access to investing abroad. So what should you buy? You buy, first of all, if you want to buy all the stocks on earth, all the good stocks on earth, all of them with just one purchase, VT. That's Victor Tango, VT. So you write VT down. If you Google what VT is a Vanguard ETF. They are going to buy global stocks, VT. So you want to buy VT, or you want to look at that VT. If you then want to buy, I bought global stock, but I want to buy a specific country. I want to buy America. Why should you want to buy America? Because America is the largest, most liquid, most profitable stock market. So you want to have exposure to America. America is VTI. That's Victor Tango India, VTI. So VTI is about 4,500 of the best American stocks. I mean best, I'm just being superlative. So you have your Teslas, your Apple, your Nvidia. So when you buy VTI, you are buying 4,500 of these stocks I'm talking about. From Lilly to all these companies, just with your VTI. So you say I want to have a portfolio. You start with VT. VT is all the stocks on earth, right? You are buying Samsung, you are buying Toyota, you are buying Apple, Nvidia with VT. Then you want to come to America. That's VTI, America. But that's 4,500 stocks. What if you want to buy just the core of the core, the cream de la cream of the American stocks? Then you buy VOO, Victor Oscar Oscar. VOO is like VTI, but it's only 500 of those stocks. So you're going to buy your Nvidias, your Apple, those really, really big boys, the biggest boys in America. That's what you buy with VOO. But let's now say you bought your VT, you bought your VTI, you bought your VOO. You now want to buy something else. You've exposed yourself to America. You want to buy something else, not American. What should you do? You now buy VXUS. That's Victor X-ray Uniform September, VXUX. That's your stocks that are good but are not in America. So with just 4 purchases, so if you just buy that VT, you bought all the stocks on earth, go to sleep. You bought everything. But if you buy VTI, you've bought all the stocks in America, go to sleep. VOO, all the stocks in America, just 500, go to sleep. VXUX, all the stocks in the world minus America, go to sleep. You buy, you reinvest your dividends, you forget about it. You don't do, I want to trade. You don't trade. You buy it, you leave it alone. Go back in 10 years and see what you're going to make. Just do it in 10 years. Just do this simple thing up to in 10 years and see where you're going to go. So now, what about Nigeria? Nigeria just there having sector-specific ETFs. So if you there are a few. Olumide can help me out. There's Vetiva. There's IBTC 40. Is it IBTC 30 or 40? There's IBTC. There's Vetiva.
So the 30 are the most capitalized stocks. Then we have pension index, just like Kalu highlighted. But for index, people need to be aware of the advantage of index. It's cheaper. It's less nausea. Just for example, instead of you to be tracking FCMB, Sterling, Fidelity, you could just track tier 2 banks. There's an index for that. You just look at dividend paying stocks. Then you look at pension, because the pension index has that's one of the criteria. So it gives you that exposure. But another thing you should look at, you should be aware, is that the upsides are not usually as high as what you get for, but it is cheaper. It's easier to track, it's easier to follow. But the difference between the index in Nigeria and the one in the US is that, if you look at the US, if we draw a line on the US chart from 1900 to 2024, it had been an upward projection, even if you use the inflation, and that's because the currency is more stable. Inflation is not as bad as many markets. So you need to look at the advantages the US bring when you're coming into the Nigerian market. So while you could look at index exposure, it has its own risk. But for me, I think one of my favorites is Stabic ITC 30. If you look at the return in the last 3 years, it's done more than 300%. And you look at inflation and devaluation, you're still doing better with that investment. However, it's not as liquid as the bank stocks itself. So it's not suitable for heavy, where people like the today individuals, where they move in millions of dollars, or have that kind of liquidity. So you need to look at your liquidity size, what you're looking at, your size of funds, and the currency risk. Currency risk is one of the major problem affecting the Nigerian stock market, and that's why personally I don't hold the Nigerian stock for 10 years or 5 years, because the currency risk really can have a toll on your real return.
Olumide, so many times you see this, somebody will post on Twitter and say, hey, my dad bought these stocks, I used 10,000 to buy Intercontinental Bank. After 20 years, I tried to sell the stock, I got 20,000. Those things are not correct. You'll be hard pressed to find any guy that invested in Nigerian bank 15 or 10 years ago that today did not make nearly, I don't give a figure on social media, did not make money. I know how, when I bought those stocks I was buying them as a student. And because of bonuses, because of results, how much I made. You see, the point is this: stocks like time. Equity likes time. The way the mathematics equations are calculated, they use time, not interest. Lots of people believe that if you put money in the bank, the interest won't make your money to grow. No, it's time. The formula for compound interest is raised over time, not over a period. So the longer you compound, the more money you make. That's why Einstein called compounding the eighth wonder of the world. When you buy a particular stock, if you buy, say, a stock for Johnson & Johnson, what you are saying is this: every year, as people buy those products and there's inflation, what happens? They will increase their prices. So there's an inbuilt inflation deflector in stock, that as long as the company is selling a product that is a necessity, the stock will keep on going up. We all use Apple phones today. Inflation in America went to 9%. Did that affect the sales of Apple phones? Is it that you buy it or you don't buy it? You can't say, I'm going to wait for inflation to come down. Look at Nestle and Maggi in Nigeria. If you're cooking your soup, you either put Maggi or you don't put Maggi. You can't say, no, I will not use Maggi. Then when inflation comes down, I start using Maggi. No, you maybe get a substitute. So you want to look for a company that sells a product that people need and people cannot do without. If you buy that company, you hold it, you reinvest your dividends. But it's difficult to find these companies, especially when they are small. See, the problem is not finding your Apple. The problem is finding Apple before everybody does. That's the problem. Again, going back to football terms, Messi is a wonderful stock. But if you buy Messi today, you are not going to make money. He's already retiring. He's at a mature stage. He's not going to win any Champions League trophy. He's not going to win anything major today. He's already mature. It doesn't make him a bad stock. It means that if you are buying Messi, you are a guy that just wants stability. Okay, Messi cannot fail now. Even if he doesn't win a cup, he will still Messi. So if I want to buy a footballer, where should I go and buy my footballer? I'll go to Nigeria. I'll go to the streets, the football academies in Nigeria. I'll buy a player there that the world does not know. I'll go and buy a Drogba from France. Nobody knows him. And I bring him to Chelsea. And when he scores goal, his value rises. Then I make a lot of profit. That's stockbroking for you. If you buy established people, then you're already paying the price of the establishment. And remember what I said, you make the profit when you buy. So what you're looking for is a good company, a Messi, that is unknown or at a lower price. And again, you might have a Messi that unfortunately the price fell because of no fault of his. Let's say, for instance, Osimhen now, wonderful striker, nobody is buying him, so his value is going down. If Osimhen was a stock, I would go and buy it today because now he's not playing, so he has no earnings. But I know that once he plays, he will have earnings. So this is how you want to look at it. Don't make it complicated. So, but if you don't know all these things we're saying, go and buy your index funds. If you don't know who Osimhen is, you don't know who Messi is, then buy your index fund, put your money there, and forget about it. Because when you buy the index, if the company is failing, to drop off the index. If you look at the index of America in 1960 and today, many companies have dropped. I think at that time you had ExxonMobil, Microsoft as the biggest players. Today it's Apple, it's Tesla at the time, it's Nvidia. Nvidia was nothing 5 years ago. Today is a number 2 or number 1 in America. If Nvidia falls off, it will go off. General Electric was number 1, number 2 for decades in America. Now they are nowhere to be found. They are gone. So if you bought a General Electric and you held that stock, you lose a lot of money. But if you bought the index would have kicked GE off a long time ago. So that's why I'm saying, if you don't know what you're doing, look for the safety of the index via ETFs. If you know what you're doing, go and buy Messi. So you look for a Messi and buy. If you don't know what you're doing, just buy Barcelona and allow Barcelona to do the scouting for you.
Yeah, just to add a little to what you said. Another problem is that it's not that many Nigerians don't know these things. Like if you look at the crypto market, for example, you see some of these guys buying pre-sale, buying coins that are not publicly listed because they know the returns are high because they are unpopular. And when the community, like look at what Dogs, a popular meme coin, had a community size of 42 million people, So it's not that Nigerians, the stigma is bad. And, sometimes, Twitter has gotten so bad that to speak with sanity has become complex. So, just like you said, my liquidity came from stock market, Nigerian stock market, for example. And like I said, I invest in at least 12 major markets around the world. So you have to start from somewhere. You're not born with royal blood, or you're not the first class, and you're complaining that a market that can give you opportunities is bad. Then something is wrong, because you don't pollute the water that will make you survive. Yes, the market is heavily inefficient. We don't have the market makers. If you look at the US, for example, just on the New York Stock Exchange, at least 4,000 stocks are listed. If you look at the Nigerian stock market, we have less than 250 stocks listed. Of that 250 stock, we have less than 20. What's 20? Less than 15 stocks worth 1 trillion naira above. And if you look at that 1 trillion, we have less than 7 companies worth $1 billion. So Nigeria market, yes, it's really, but that's how we are. That's how we are. The market is not a is not blown, but the growth upsides are high, like Alu said, because the market is going through a discovery phase. And don't forget that in the last 3 years, the Nigerian stock index has been doing well. In fact, I was pessimistic about Nigerian stock market because they got two downgrades from the United States and the UK. But if you look at the Nigerian stock market now, it's really domestic participation. So just imagine the index comes to play where during Okoji where you have the MICS was listed, where once it's not going to be, our probably definitely be optimistic that something good will happen. You have to bet also that if things go well, you come in early. Last year, people that discarded, even me, for example, I don't have an exposure in Oandu, but I have friends that, despite their pessimistic, they still kept holdings. And now look at what the stock has done to their life. You had 10 million naira in last year. Now it's giving 110 million naira. Tell me how bad it is. So you need to understand that in life there's risk, and in life you should also take what you have. Life is not fair. Use whatever resources you have. If you want to target the United States, start from where you have. If your friends give you dollars, then you can forget the Nigerian stock market. If you know you're as rich as can, then invest in Apple, Google, Nvidia, no problem. You don't need to come to that. But if you know you are somebody struggling to even eat shawarma, and it's somebody that really has weak disposable income, please, the Nigerian stock market is the place for you to start. Thank you.
I think we have the gentleman back. The W in exclamation. I think it's back now.
Yes, I am. Thank you very much. Most of what you said I've answered the question I had, but just to buttress. So, like I said, I won't say I'm new into investing, but I just got more active around last year. And the main question I was going to ask is, Olumide mentioned something earlier about having diverse tools that you could use to, make your decisions as to what to invest in and all of that. Personally, for the past few months, I've been using just two different sites that I know of, investing.com and Wall Street market or something like that. Simply Wall Street, sorry, to be able to make my picks and look at the technical analysis. But I don't look at it in depth. I just go to what has been pre-put there and just see which they insist might be a good buy over the next 1 month or over the next 2 or 3 months. So my portfolio is a bit balanced between the well-known stocks and also a little bit of penny stocks here and there that could be really, really volatile. So I just wanted to ask, is there a better way that you could possibly go about this? Is there a better way that you could possibly use these tools, or a better tool to make your research and buy these stocks as soon as you can? And I've also heard what you said about the ETFs. Personally, I'm just starting off my life and my career, so I won't say have the disposable income for dollar-based ETFs like Carlo has mentioned.
How much do you think I'm talking about? Not a lot of money. I'm not asking to buy an ETF.
Yeah, I do understand that it's not a lot of money. But yeah.
10,000 naira.
I do.
Olumide say, don't mind Olumide, 10,000 naira. I mean, see, I want to ask you a few questions, but don't. You can afford it. If you live in Nigeria today and you have a phone to buy foreign stuff, I didn't have that advantage you guys today have. When I grew up, you could only buy stocks in Nigeria, and you had to physically go to customs building or daily trust building in Lagos and to buy your stocks. There was no internet when I was growing up. Now you can sit in Kwara State and buy FCMB or buy VTI. Don't take it for granted. You've got to invest. Now you are in a global village. This is the real global village we're talking about, where you can wake up and expose your savings to earnings in dollar, in naira. That's where I'm going to. But let me ask you a question back to you, and let me ask you, when you want to buy a stock, what do you look for? What is the main indices? How do you screen? Because what you're asking me is the screen. Do you know what I mean by a stock screener? You know a stock screener?
No, not necessarily. I appreciate if you could explain that.
So when if you Google stock screener, what it does for you is that you will tell the computer, I want to see only stocks that have a PE of below 10, that have a profit margin of 40%, that have a return on equity of 10%. You will tell your screener. Your screener will then screen all those stocks and show you only those ones that you want. So how you want to buy stocks, you have to have your own internal guide. You have to say, okay, inflation in Nigeria is 35%. So stock screener, show me only companies who have dividend yield of above 40%. For instance, it will give you those companies that have paid dividends above 40%. If you're looking for a dividend return, if for instance you're looking for a long-term return, you say, okay, stock screener, show me stocks that over the years have done a return on capital of 10%. When you Google stock screener, you see many of them. There's FinViz, there is many of them. Most of the sites, even the investing.com you talked about, they all have stock screeners. It plugs in your variable and cleans up the number of stocks that you have. So you're not looking at 1,000 stocks, you're looking at 25. So when you then have your short list, you can then go in detail and say, okay, what makes this particular stock tick? How does it make money? Is it making money because it's selling goods, or it's borrowing cheaper, or it has a large market in, say, China? You want to find out why it's making money. If you know why it's making money, then it's simple. You then go back and say, these variables that make it make money, can they continue for 5 or 10 years? That's how you want to price it. Remember, what we are trying to do is to get a value. If I get a value for any stock, I can make $1 billion. Warren Buffett is a billionaire today because he can estimate values really, really well. So if I know the value of FCMB today, what will I do? If I say the value is 15 naira, I'll buy today because the price is 7 naira. Because ultimately the market will go up to 15 and I make a lot of profit. You see? If I know the value of a company, I can then buy or sell that company. So I can buy or I can short the company because I know value. So it's very difficult to determine the value of something. If I ask you a question, if you have a mango tree at the back of your house, how do you value that mango tree? Do you say all the mangoes that it produces every year, I would sell them and that's the value? Would you say, okay, the shade it gives me when I sit on it, that's the value? Would you say, oh, the oxygen is giving to me, that's the value? It's very, very difficult. What I mean is, there are calculations that you can use to get value, but it's a guesstimation because you are looking into the future and you have no means of knowing what's going to happen in the future. So you have to make an assumption today about the future. Hence to my question, why is the company making money? Is it because it's in China, or it has a large market share, or it has a large product base? If you find that answer, then you ask yourself, will this answer stand for 10 years? If, for instance, right, look at NVIDIA today. Do you know who NVIDIA killed? Intel. If you go back 15 years, Intel was as American and as blue chip and as massive as you could tell. But Intel did not invest in Apple, making Apple chips for Apple, and that's where they lost the whole race. Today, Intel is nowhere. They're getting loans or grants from the government in America to bring them back to speed. NVIDIA is now worth 3 trillion. Or is it, am I correct? Something trillion, NVIDIA. So if you ask the question of Intel, if you had asked, where is Intel making money from? And you didn't answer that question, can they still make this, are these conditions still right for 10 years? You would have seen that Intel, the price was going to fall because they're not going to be there in the next 10 years. So to answer your question directly, try to use stock screeners and don't reinvent the wheel. Google what stock screeners does Warren Buffett use if you want to do long term. If you want to do short term, look for your favorite short term trader. What stock screen element does he use? Put it on yours and reduce your number of stocks to 5. When you have 5 stocks, then you can look at them critically and move with just the 5. Don't be everywhere. If you're everywhere, there's too much information. Focus on your 5. Trade your 5 and move on. Right. That's what you want to do. I think he has dropped off again. We got Shalom Knight. Shalom Knight. Thanks for also holding. Go ahead.
Hi, Carlo, good evening. Olumide, good evening. Thank you very much. I've really, really learned a lot from this space. So many insights being shared. And so I would want to ask a whole lot of other questions I had. Let me just go straight to this one. So this is about ETFs, right? We've spoken extensively about ETFs and equities and all that. But if we want to compare, assuming I'm a low-risk investor, I don't want to take too much risk, so I want to just stay within the ETF end. And like Olumide mentioned, if you don't have so much liquidity, Nigerian stock market is a place to start versus the US stock market. I know you brought a balance to that, Carlo. But if we look at the projection, let's say 10, 20, 30 years, with an ETF in the US, I could just do my compounded returns. And I just know, on average, what I could get year over year compared to the Nigerian stock market and what it will offer me and what inflation will do to that. So would you say when it comes to low risk investments, but still, playing in the equity market through ETFs in Nigeria versus ETFs in the US, as someone who does not have a lot of liquidity, if you could just say a thing or two about that? I know you said it in different ways, but I just want to get your thoughts.
That's a great question. Let me have you mute. Okay, I'm going to mute you. So it's a great question. I'm sure Olumide will also chime in. Look, let's use football terms again. Let's look at the English Premier League. So your question is that should I invest in Manchester City or should I invest in Leicester in the second league? Leicester is Nigeria. Man City is America. We know that whatever happens in the league, Man City will not be regulated. We know that even before the league starts. We know that before the league starts, that Man City will not be regulated. That's your risk-free now. So you are saying you don't want to take risk. So if you don't want to take risk, you know already that Man City will not be regulated. Because everybody knows that the return on Man City is going to be very, very low. Because already we know they would never be relegated. Same way with stocks. We know that the American stock market averages just about 6 to 8% return year in, year out. The American stock market would really melt and go into total meltdown. If it happens, then the whole world goes into total meltdown. So because the American market will not melt like overnight, the returns on the American market will be lower than the returns on a Nigerian market that, quote unquote, and I'm being open, just use of English here, that can melt more than the US market. So it comes back to your risk, how much risk you want to take. If you want certainty of returns, then you want to buy into the US market because it's the largest market, most liquid market for a long time, since 1800s, right? But if you want to get that bump, that sugar, that growth spasm, of course you don't want to be in the US market. You want to be in the Nigerian or the Asian or the African market, where in Nigeria, one particular stock, Dangote Cement, caused the entire stock market to become the best performing stock market in the entire world. It's happened twice. I think 2022 and I forget the other year, when Dangote Cement alone caused the Nigerian stock market to be the largest and best performing market in the entire world. So we don't want, I don't want to buy Man City, I don't want to buy Leicester, because what if I lose and Leicester won the Premiership that year? Remember that this year Leicester won the Premiership. A guy invested £55 and made about, is it £5,000? Because it was such an outside risk that when it made money for him, he made money. Apple, that today is a $3 trillion company. Remember, Apple was going bankrupt. And Mr. What's his name? The gentleman that died. He didn't have money to run Apple. If you had bought Apple then, imagine the money you have made today. Microsoft. Remember Microsoft? This story of Microsoft. They got money from a guy that owned the store. I think it was Radio Shack. The guy gave them money and they gave the guy shares. And the guy said, no, not just in shares, give me cash. If the guy had held onto those shares today, what would it be worth today? The point I'm making is, why not buy two of them? Why not buy Man City and Leicester? So you can say, if Man City goes up, in my portfolio, I'm getting the stability. In my portfolio, I'm getting the growth. So because you are younger, you want to buy that portfolio. As you start to get older, you remove Leicester from your portfolio because you don't want to take any risks anymore. So investing is all about who you are, not the investments you want to make, who you are. If you are younger, you have the ability to take more risk. Hence, you are exposed more to variable income in the capital market, because if you lose that money, you have more compounding periods to catch up. As you get older, it's advisable you strip down the risk more and you go more into fixed income. where you're not being seduced by the returns on the other markets, but you are saying, because I have less compounding periods, if I lose 1 million, I can't catch up again. So I'm going to stay with fixed income. So your question is, what should you do? I would say you should, number one, be in equities if you are younger. What equities? I would say you have to have US equities. And you know, the funny thing is not a mutually exclusive question. You can be in US equities and you can be in Nigerian equities. It's not a lot of money. You can buy US equities at fractional basis, which means you don't have to buy one stock of Tesla at 200. With $25, you can buy the Tesla. You buy the fraction of the Tesla. So you buy your FCMB at 7, you buy your Tesla at the fraction of the price. It's in your portfolio. All hooray to you. You get the points I'm making. So don't mutually exclude it. If you are younger, take advantage of the global market and diversify your earnings, diversify your risk by investing in the US, Canadian markets, Japanese. Do that. If you are, as you get older, reduce your exposure to equities as a general rule. You have the opportunity, take advantage of it. Olumide, you've got the floor.
Yeah, so just to add to what Kalu said, a $1 million investment in Facebook in 2012 is now worth at least 130 million naira. Just even say you invested 1,000 naira, you know, you've gotten times, if you adjust the currency, the exchange rate, and the share appreciation. You see, the problem with the investment culture in Nigeria is that we've forgotten that if you can't develop an habit with the easy part, you find it difficult with it. So just like what Kalu said, that's the strategy I use. So for example, US stocks for me are long term. When I mean long term, I've held US stocks for at least 9 to 15 years. And the reason I could do that was that I had liquidity elsewhere. I had skills that could give me income, and I had things I was doing. And another reason was that the companies I bet in, so I'll give you 2 companies example. I had exposure in Google and Facebook. You know, Facebook came out with IPO. The IPO even disappointed. It even dropped by 30-40%. But my bet was that my bet was not even on Mark Zuckerberg. My bet was on Sandy Sherryberg, the CEO. Because I remember when I'm addicted to a company, I look at the management team, their style, and people that I think can make things happen. So I read her resume. She worked with Larry Summers, the former US Treasury. So I dug deep into her style of, and I saw this woman who bring in sanity. Yeah, this guy looks like a techie young guy that might not be able to control finances. So my bet was on her, and it paid off. Now, if you look at the stock has really eroded some of my seed investments like BlackBerry, Credit Suisse, and what have you. So it's good. But you see, the reality is that the average Nigerian does not have that liquidity to break into alpha. When I mean alpha, to be consistent, that will be able to over the long period. So, for example, if you kept 1,000 naira in that stock, well, you could say you made like 130,000, but does that really? So, what I tell people naturally is like, act like your richest man. Now, don't act like me because I'm not a rich man. Act like Tony Rimelu, act like Dangote, act like Tony. How do these guys do it? These guys have FX exposure, they have local exposure. So, just like what Kalu said, what I'm saying is that you have to be bold. That's the difference here. You have to be bold. You have to measure your risk. What investments am I taking in? What are my investment horizons? If things go down the ladder, because things will go down the ladder, trust me, a lot of people cried in the stock market in 2001. Tech. A lot of tech stocks became newspapers. But look at it now, the top 3 most valuable companies in the world are tech companies. So you have to understand that even good things, bad things happen to good things. I give you an example of Credit Suisse, a bank that was too big to fail. You know, this was a Swiss bank that has been older than a century, even older than when Nigeria came to be. But the bank went under. So good things happen to bad things. So you must be aware that bad things could happen. But it's how you position yourself. A lot of people don't understand that right now there are investments that are giving risk returns of 20% per annum. So if you're a middle class Nigerian, for example, you're earning 300,000, while you have little exposure in US stocks and the local stock, you could have passive income also in the fixed income space. As you grow, you get to understand the fundamentals of each market. Then you start, because you are definitely going to make mistakes. Just like Carlos said, we grow in the market. People don't become genius by just reading books. And that's why financial market is unique. There are a lot of people that have been geniuses that have committed suicide just investing. Nobel Prize winner of economics lost 4 billion in the stock market due to derivatives. So the stock market does not respect your CV, your resume, or your historicals. A lot of brilliant people become stupid people in the market because market has the way it moves. So you really have to have the experience, and you really cannot just be listening to people because people have bias. Some people might want to use it as liquidity to pool, maybe to sell their asset. Some people might be selling because they are part of the business. Some people have different. So you have to have that ability to decide. And that's why it's very important to start early, because as you grow, you now see, oh, these are quality companies. Because, for example, I missed NVIDIA. I didn't see anything that I missed. I didn't see NVIDIA. I missed Warren Buffett. So you can't get it all, but just make sure the ones you get in, you get it very well, and you stick to it. So I just wanted to add that color.
And to end on this statement, you can't get it all, but you can with ETFs. So if you bought VT, you'd have bought NVIDIA. If you bought VTI, you'd have bought NVIDIA. So we're saying the same thing, right? We're saying take advantage of what's in front of you. Take advantage of one of you will buy crypto, but you might not buy stock, or you think crypto it's easier. Take advantage. You don't have to trade. If you hear, I always say buy and forget. It's not a casual statement. Buy and forget. This trading matter, I want to trade. Buy, reinvest dividends and forget. Abido Shaker, I got the floor. Abido Shaker, what's that? Odogu Naugu. Got the floor, go ahead.
Hello, good evening. Hello.
How are you doing? If you could speak up, sir, I would appreciate that. Thank you so much.
Okay. I hope you can hear me.
Clearly now, yes, sir. Go ahead.
Okay. So, yes, I don't need to drag us back, but you mentioned something earlier about CSCS number and how secure trading or buying stock with regulated agencies, let me call it that. So I started my investment journey this year. I've been following you and Olumide since like a year or two now. And last year, Olumide really did the number or two on me about investing, and I promised myself I was going to start this year. And then, luckily for me, I found a certificate, a share certificate that my father bought in Springbank, old Springbank. And I was wondering, when you brought up this issue of, even if the certificate is wrong, you just have to take it to, for what you mentioned. And it got to my mind, I wanted to ask, this bank now is no longer in existence. Springbank is no longer in the country. So does that, mean that the whole share is, it has disappeared? Or does it get moved to another thing?
Yeah, great question. So overall, I meant CSCS, that's Central Securities Clearing System, that's the official name. So what it is just a digitized version. It's like digitizing your share certificates. So let's say you bought Springbank. What you want to do, Google who bought Springbank. Google who bought Springbank, right? Or whatever bank or whatever company. Google them, then take your certificate to registrar. I do not guarantee you make any money, because sometimes when they buy this company, they can say all obligations are extinguished, which means that your investment in that bank is gone with a new purchase. But if it's a merger, yes, if you go to the registrars, they can tell you, oh, with this share you have, maybe with 10 shares of this, you have 1 share of that, and they're able to print you a new share certificate and give to you. So you can do it yourself, or you can pay your stockbroker to do your investigation for you, and they can find out. Many times, I know many stories, people, their parents have passed away, they go to their old home in the village, they find share certificates in a box and they say, what is this? It's just paper. That's money, bro. Take that to your broker and ask your broker. I mean, there was a big case way back when I was still in investment banking where some guy brought shares of, was it Nigerian breweries, Nestle, far back. He didn't know his kids, his brothers had gone to the house, sold all the goods, and didn't know what share certificates were. His father had passed on, and this guy brought certificates that were issued by the past government, all certificates worth millions. So you never lose your shares as long as your name is in the registrar of companies. So what you try to at least go to registrar, take 2 forms of ID and say, hey, is this worth anything? Same with your dividends. If you know now, guys, there's the new dividends law that says if you don't claim your dividends, the government will quote unquote borrow it from you. So if you have bought shares in a company and the company has issued you a dividend and maybe your address was wrong or you didn't collect your dividends, the company keeps those dividends in a fund called the unclaimed dividend fund, and every year they publish your name. If you don't, so every year you see your name published, the money is still with the company. Okay, now the government has said that those shares should be transferred and the government wants to borrow it. So what you should try to do, if you're not sure, maybe your dad had shares, if you know the shares where the company where you had shares, go to registrar and ask them, I want to do investigation. If you have a will or you have documents to show it the next of kin or a list of administration or any of that, go there and say, I want to just check. It doesn't mean you would have, but you can check and say if you had any. If you had any, then you can commence the process of getting it to yourself. So I hope that answers your question.
Yes. If you can repeat the last point you made about going to, if your dad had something you want to check, the dividends.
Take 2 forms of ID. Take the legal paperwork that say make you the legal next of kin or letter of administration, and you go to the registrar and you say you want to find out if he has unclaimed dividends or even unclaimed bonus certificate. If he has, they can print it for you on the spot, i.e. the dividends. The share certificate they can reissue, but the dividends literally they print on the spot for you. You can get all that back. So if it's a lot, give it to your broker to do for you. Just make sure your documents are intact. They'll get it done for you. Yeah.
Okay, thank you so much. I appreciate. I appreciate your input so far. Thank you.
All right. And then someone is asking, what's the difference between an ETF and a mutual fund? So ETFs are almost like mutual funds. Mutual funds are just how Americans call them. Nigerians will call them unit trust scheme. So you see, unit trust scheme is how Nigerians call it. But unit trust schemes have a trust deed. Mutual funds really don't. But it's just nomenclature. Americans say mutual funds. Now, an ETF is a mutual fund that trades during the day. So exchange traded fund. The difference is this: when you buy, say for instance, CSL has a mutual fund. CSL is owned by FCMB. They have a mutual fund called the CSCS Money Market Fund, right? The price for that fund is quoted to you at the end of day. So the net asset valuation is done at the end of day. So if you want to know the price of that stock, you have to go to the broker. They will tell you, okay, after trading, we'll give you the price. Then you go end of the day, they give you the price. With an ETF, it's trading during the day. So it's trading like a stock. So when you buy VT, you can buy it, sell it during the trading cycle. You don't have to wait till the end of the day. That's one advantage. The other advantage is got some tax consequence that might be getting into the weeds. But it's almost the same product. It's a product that buys assets and holds them and tracks an index. When we say we're tracking an index, Nigeria has 200 stocks. This IBTC 30 or any money market will just really track 30 stocks in that whole list of Nigerian stocks that are quoted, and it's going to use, if you buy that index, you're automatically buying the 30 stocks. And there are a few in Nigeria, like I said, Meristem, IBTC, CSL, FCMB. Most of them have all these funds. So diversify, and it's cheaper. ETFs, unit trust are cheaper ways for you to buy. You don't have money to buy one Tesla, buy the ETF. You don't have money to buy FCMB, buy the unit trust or buy the money market or buy the equity fund, you're also buying those stocks, right? That's the way to do it. Big E, lots of fruits on your timeline. How you doing, sir? Go ahead.
Very well. Good evening, Mr. Carlo. Good evening, Unlimited. Thank you so much for all you guys are doing. I really appreciate this. However, I have a couple of questions around this, but even though some of them have been answered, some people have answered. But this specific question is, okay, several years ago, I think I opened a CSCS account, and I relocated from where I opened it. I can't even find the stockbroker. I can't remember his name. How can I retrieve that?
Wow, I think your best bet is to just try and do an investigation. Go to your current stockbroker, give them your name, give them all that information. They have to go and search literally manually all the other registrars. That's basically what you want to do, since you don't know where you bought it from. Because it's not, they are looking at the registrars. So how many registrars do we have? Not up to 20, right? Because one guy can manage 5 stocks. So you can do it yourself if you want to save money. Write to all the registrars and say you want to check if you have any holdings with them, because your name will be with the registrar. You understand? So if you, for instance, if you bought First Bank, there's First Registrar. You get what I mean? So you write to First Registrar and you say, hey, do I have any shares with you? Or just go through your broker.
Because during that period, I could remember I bought some of those IPOs, Oceanic Bank, Spring Bank, and names, and some of these certificates were given to the stockbroker after opening the CS account, and I can't remember. This is like 12, 13 years ago.
Yeah. So like I said, you never ever lose your certificates or your dividends. We just have to identify where they are. So if you bought a company that is no longer in existence, then the company is gone, so your shares are gone, right? That's simple enough. But if you got something that was merged and you find the registrar, if you go there, they can tell you, oh, when we did the scheme of merger, it was a 10-for-1. So for every 10 shares of Bank X you have, we're going to give you 1 share of Bank Y, things like that. So you have to find out the registrar and go there, and they'll tell you, oh, sorry, this company is no longer in existence, it's been bought by this company, so your shares are extinguished, or there's a measure and you have this. If you have dividends, they will look it up, they will print it out for you. It's all in there, really. So you've got to just try to find the company or the registrar where you are, and they can take care of you. Yep.
And you can do the easiest part, which is just start this night, go to the SEC website, dividend search, everything. You look at your names, look at the stock. The only problem is that you might see similarity with names that have the kind of stock you have. So just be able to look at names, then look at the registrar of that stock. Just visit, like you just go, so you won't just waste your time and money going to different registrars. So you see the registrar in question. So you can start this night, go to the SEC site, you see all dividend search. You see your names, you see names of stocks that
do it right now.
have.
Yeah. Go online. Only if you can share that link as well. Go online and just look and just start on your own. So at least you can narrow down the search to where you physically go to. Yeah, makes sense for you. Yeah. Thanks, God. Yeah, thanks, Biggie. Shoaib, Biggie, are you okay?
So
you're welcome. Excellent.
Yes, I'm fine. Thanks so much. Only I would appreciate if you share the link with me, please. Thank you so much.
Only can you just confirm to me what's the Nigerian stock market doing, the NST index? What are we doing right now? I'm seeing a figure I'm not sure of. What are we doing right now?
I don't understand.
The NXT index, what's the return year to date so far?
Okay, almost. I think it's around 30 plus.
Okay.
I think it's around 30 plus. Yeah.
Okay. Just okay.
Yeah.
Okay.
But the market capitalization is around 5 trillion. Yeah.
Okay. Excellent.
5.5 trillion.
All right. Well, gosh, Shabu, how you doing? Thanks for holding on. You're dropping in now. Thanks for coming back. What's up?
I'm fine, sir. Good evening, Mr. Kalu and Mr. Olumide. Thanks for the help you are rendering to us, the younger ones coming up. The Lord bless you massively in Jesus' name.
Amen.
Can you hear me? Can you hear me from your end?
Yes, I can.
Okay. My questions are two. One is to Mr. Kalu and the other one is to Mr. Olumide. Now, the first one goes to you, Mr. Kalu. These informations you have now that you are using, did you have them when you started making your investment? I mean, do you have all this information before you started? Back then when you were in school?
No, I didn't. Back then,
Okay.
back then, the only information you got, there was no internet. The only way you got information, they used to publish something called the Daily Market Report. So you'd have to go to your stockbroker and then get a copy of the Daily Market Report. It'll tell you what stocks went up, who has given results, and all that. And then, of course, the newspapers will publish stock price for the day. So I used to look at the newspapers and look at the stock price for the day, and then I go to the brokers and I get the daily market return because it's in VI. It was in VI, Daily Trust Building. That's where all the stockbrokers were. Then I bought something called Microsoft Money. Remember, back then, there were no computers. I remember I bought a particular stock and they gave me a bonus. And I remember I went to this guy that is now a big man. What's his name? Please, he sells phones in Lagos. He sells phones. IT guy. Give me his name, I beg. He sells phones now.
I can't remember his name.
No, somebody he sells phones. He's a very, very big guy. He sells phones. He does. See, I went to that guy. He was in Computer Village. Back then, you couldn't buy a computer off the shelf. You have to pay them to build for you. I paid him. I was the first guy he built a computer for. I think he charged me 3,500 naira because they had a monitor. Then he built me the motherboard. So he got monitor, keyboard, and he built me a computer. That guy is not a billionaire. Then I bought something called Microsoft Money. It's no longer in existence, Microsoft Money. So I would then go online, not online. I loaded it like CD-ROM on the computer, put the stocks I bought on it, and I'll update the price manually. So I remember when I come back from holiday, I go to Daily Trust Building, I get a copy of the Daily Market Return, I go back home, I put my computer on, and I update the price, and I used to track it there. That's how I used to do it now. I can do all that now on the phone in 2 seconds, but that's how I did it. Yeah.
All right. Thank you, sir. Now to Mr. Olumide. Sir, you always emphasize that if you don't have so much liquidity, you shouldn't go into the American stocks. Now, my question is, what even if you don't have so much liquidity and maybe the one you have, you are not planning of using it anytime soon? Maybe you are looking at 5 years to 10 years horizon. Is it not okay to go into American stocks due to the inflation in the country? Thank you.
Yeah, it makes a lot of sense. I think Carlo put a balance caveat that, well, you could be exposed to US ETFs. But you see, one of the things I've learned about investing is that behavioral finance plays a role. When I mean behavioral psychology, so you have to learn everything. Because you see, if you look at the lifestyle of Warren Buffett, Charlie Munger, you see that these guys were not the best guys when you talk about academicians, but the experience, the discipline, the ability to hold, patience, all these things played. And it's how investing works. And that's why I said you can be smart and be very stupid in investing. And you could be quite stupid in investing and you could still get some entry. So you really need that exposure and experience. And one of the things I've learned about life is that you start from the easiest place in life. Now, for me, I have seen that personally, I've seen that I can suffer naira losses than dollar losses. So my mistakes in naira were easier for me than dollar mistakes. Now, I'm not saying that, like I said, Carlo has put a balance, because you can definitely be exposed to index or ETFs where you could put in as little as 5 to 10,000. But for me, I think what matters most is the habits you learn along the line and the experience, the exposure that comes into play. So if you can really move in, because Carlo started from Nigerian stock market, I also started from Nigerian stock market, and that's why I laugh when a lot of people make excuses, because I know a lot of successful people that send their kids abroad with Nigerian stocks, so I know a lot. But you see, I also know a lot of people that stock made them miserable. So I tried to see the mistakes they made, and I saw the successes of. So like then there was nothing like online availability for financial information. I use Guardian EOD. I try to look at the high, the lows. I try to look at the trading volume. I try to look at the component of the stock index, compare the stock with its peers and things like that. So basic information. But now, US stocks also has their own advantage. Like you see currency alone. But it has shown that, because what the crypto market has shown is that it's not that many Nigerians are intelligent. Look at crypto, for example. A lot of Nigerians are invested in crypto. But you see, when the meltdown happens, you see some people that and they made 50, 30, or even as much as 500, now talking about going to McDonald's or Mr. Biggs to work, because they did not learn the habits along the line. Because, see, investing, as much as it looks interesting and it's the best way to grow when you have liquidity, it can also, you probably not manage, it can also make you cry, and cry bitterly, because we also need to look at people that have made mistakes and learn from it. And that's the only problem I have with crypto. It's not that crypto, I have exposure in crypto, but crypto teach you bad habits. Because there are a lot of people I know, they'll tell you, I would say, why don't you consider stock? Say stock, Nigerian stock. Stock that, and when I just look at someone, when I swap 6 or I look for a meme coin, give me 6x. Their thinking is quick. And it's not that they're wrong, but trust me, it's not for the weak. Because you see, if you look at the way Mimi has acted this year, for example, at some point it hit hot on in April. Right now, it looks like life is underwater. So you have to be able to intellectually swim in these territories by learning. And learning comes from experience. And experience comes with time. And that is one of the things we really need to have, the culture of not having quick money. Crypto investment, US stocks, they're not bad. If you look at Facebook, the way it's rise, the way it rose, or Meta or Google, they didn't just start from day one. Look at the graph. There were times of consolidation. There were times of dips. Then triggers. So you have to, for you to make a lot of money, you have to capture the whole trend. Simple. You cannot be a trader. That's what I can't say. And that's why I discourage trading for many Nigerians. Not because trading is bad, but because many Nigerians don't have the liquidity, the intellectual skill, the technology to make a lot of money from trading. And you could see that these are things that big players like banks, hedge funds do. So why don't you stick with things you have eye on? And that is where my own sentiments are. I always like people to stick with things where your odds are high. Thank you.
All right, well, gradually winding down. I got Saglicious next, but let me just make a few comments, right? So if you want to invest, there are many ways you can do it, right? But the one proven way is to do what they call top-down. So top-down. So you ask yourself a question, which sectors in the world or which nations or which continents are good? I like using that word good. You say US, blah, blah, blah. What if you say Nigeria? So let's say you want to invest in Africa. What are the top 5 economies in Africa? I mean, you say South Africa, you say Egypt, you say Tunisia, Morocco. Of course, Nigeria will be there, right? So Nigeria is there. So you are now in Nigeria. Where should you invest in Nigeria? What sector? The top 3 GDP sectors are agriculture, trade, and IT. But these sectors are not really in the stock market. With agriculture, you have Presco, you have Okomo, but not a lot of agri companies in the stock market. IT, we like MTN, we like Airtel. They are in the stock market, right? Trade, not a lot. Dangote is a one-off, it's an outlier. It's in industries. That's the biggest stock in Nigeria, outlier. Banks, Nigeria, right? Growing, like I said, in GDP, 60%, right? Banks and insurance growing. So you want to invest in banks and insurance. Okay, which bank do you want to invest in? You want to invest in one that is growing to grow, because remember what I said, the greatest or the best estimator of if a stock price will go up is earnings. If earnings go up, the price is going to go up. So if you look for a company that's going to make earnings, then of course the price is going to go up and you're going to make profit. profit. So which bank, Nigerian bank, going to make earnings? Again, football analogy. You want to buy Messi at a cheap price. There is no point buying Messi at 1 billion a season. He will score goals, but it's at 1 billion. Where do you make your money back from? So you want to buy Messi at a cheap price. So let me give you an example of how you say cheap. If I was to buy a bank and I said, okay, I want to buy a bank that is a top 10 in Nigeria by assets, loans, and deposits. So for instance, look at FCMB. They are top 7 net assets in Nigeria, top 7. FCMB, of course, has a PFA that is top 5, has 830 billion in assets under management. They have a PFA that is top 5 in Nigeria. In terms of their Credit Direct, they have an AI-driven platform that is number 1 in consumer finance in Nigeria. Number 1 consumer finance in Nigeria. Their capital markets, they are numbers 2 on the FMDQ league table. Number 2. CSL, their brokers, are top 5 of executed trades in Nigeria. So you are buying into a quote-unquote Messi, or whatever you want to call it, that their brokers are top 5, their capital market guys are top 2 on league table, their Credit Direct is the number 1 consumer finance app in Nigeria, their pension firm is top 5, the FCMB bank itself is top 7 in terms of net assets, and you are buying it at how much? It goes back to the analogy. You want to buy a good company at a cheap price. Their PE is 1 times 1.3. So you are buying at this 7, it's less than 2 times earnings. It's not the problem of if the stock is expensive or cheap, but you're buying quote unquote good at cheap. And you are saying that if you put money in this company, will it grow in the future? Will the money you give them today allow them to grow faster than Nigerian inflation to give you a real rate of return? That's your question. That's the only question you have. If you give them a naira, will they grow? Do you need your money to grow? Or are they already established, meaning they're going to use their own assets to grow? I think they need your funds to expand and to become a tier 1 or to challenge the tier 1. They are already challenging tier 1 in terms of their output. I'm bringing it back to how you want to invest. And that's how you want to ask those questions. You want to ask, will this naira I'm going to give them allow them to compete and create earnings for me in the future? It's all about earnings, not events, because you're buying this stock, public offer, you're going to hold it at least 6 months, right? Public offer, earnings, that's what you're really looking at. So I hope that sort of gives you guys a bit more clarity on how you want to do that. Sagashos, you've got the floor, Sagashos. Thanks for holding on there. Sagashos, are you there? Olumide?
Hello.
Yeah, go ahead. Go ahead, sir.
Good evening, Mr. Thank you so much. I think we have learned so much. So I just have a simple question or help per se. So I have Dangote Flows shares before now. So I was not aware when they folded, and I'm trying to still figure out how to get. I know that they were bought by another company. So I don't know if I have a share. How can I locate the current company, or when they now went private, the shares have gone, like you said in the other explanation? Thank you.
Or just go online. It doesn't mean the shares have gone. It depends on how they went out of business. If they merged, of course, you still have interest in the merged entity. If they were bought out, you might still have interest. But if they have liquidated and collapsed, there is no more interest, right? It's gone. It's extinguished. So you want to go online and try to see what happened to them, or if they were bought, who is the new registrar. Olumide has said, go online to the SEC site, put your name in there and see if it pops up as a registrar. Then go to that registrar, or just Google, find out what happened, or pay a stockbroker. They're going to do exactly what I'm telling you, and they'll find out. You want to know what happened to the entity, because once you know what happened to the entity, you can then know exactly how to track them down. Yeah.
Okay, thank you so much. Because I checked and saw my name on the unclaimed dividend list, so I filled the online e-dividend form.
Yeah.
And,
that one is
but then I will still do as you advise. Thank you so much.
Correct. For the unclaimed dividends, it's like you have money out there which they will give to you. So that one is different from like your share certificate, right? So once they have announced the dividend, even if they have folded, they must still give you that. It's your money now. It's no longer their money. So if you see your name on unclaimed dividend, please go and get that one. That one is easy to get. You go to registrars, take 2 forms of ID. They will print it there and then for you and give you. So that's your cash. What I'm worried about is like your share certificates that show your ownership in equity. That's one that might take longer to find who they are, and they have to print you a new certificate from a new owner, things like that. So if you have unclaimed dividends, go get it on Monday, just on or whatever, on Tuesday, print it out.
Okay, thank you so much, Mr. Khan.
All right, excellent.
Thank you.
All right, Olumide, I think we're almost come to the end. We spent like an hour, nearly 3 hours. We've got up. So should we start to round down the room?
Yeah, yes.
Great. So any last thoughts, Olumide, before we shut it down?
Yeah, for me, I think...
Oh, sorry, we've got Gospel.
Okay.
Yeah, Gospel. Sorry, we forgot you. Gospel, go ahead.
Okay, yeah, thank you. Interesting conversation so far, Carlo. So mine is just a question, something you said earlier, but I just wanted some sort of recap as you wind down. I've never invested before, so I'm a novice in this area. I just recently got picked interest because of the recent bombarding we've been seeing from banks telling you to buy and whatnot. Now before, the rhetoric has been, just like you said before, my grandfather bought shares the other 50 years ago. Today is worth 2 naira. That has been the rhetoric. So I just have that feeling that, if you buy, you are going to, even if you wait for 20, just like you said, that time was the most important factor you consider, in this, especially in equities and the likes. And then somebody tells you, or what you mostly hear, whether rightly or wrongly, is that you buy, even after 50 years, you buy a stock at 9 naira per share, for example, and in the time you want to liquidate, you're saying 3 naira and all that. Though you mentioned that, well, that was typically not the case. Maybe you are going to touch it later when you respond. But I took my bad when I was writing earlier when you were describing how to start to buy, the apps to download and the VT and the VO and all that. But I just wanted you to give some sort of quick recap of, again, the apps to that. I know you mentioned the apps, Bamboo, Cowrie Rise and all that. Just a quick recap around, getting into the equity, getting into investing and bonds and, all of that, getting into the system as somebody who is interested for a novice, if you like. Thank you.
Okay, good question. I think the very, very first thing you want to ask yourself when you want to invest. Let's start from the very beginning. To be an investor, you have to earn money. So you are earning money. When you earn money, you want to save money. So what is savings? You don't spend the money. Once you don't spend, you have saved. Anybody can save. Saving is not spending. Investing is taking that saved money and putting it away with intent. So you have earned, you have saved, you now want to invest. The first question is, why are you investing? The why determines where you will invest. There is no one size fits all for investing. If I am investing because I want to save for my retirement in 25 years, the way I will invest will be different from if I have my rent money and I want to invest it for 12 months so I get the money back and pay my landlord. I just want to put money away for 12 months. So why you are investing is the most important question. If you tell me I want to invest for 5 years, I'm going to retire in 5 years, so I know what I'm going to advise to you will be different from if you were a 20-year-old guy saying, listen, I just made $1 million because I got married. Someone gave me a check of $1 million and I want to invest it for 25 years. It will be very, very different. So the first thing I'll tell you before you start to invest, ask yourself why you are investing. Why means, is it for long term? Is it for short term? How old are you? What type of risk do you want to take? If you want to invest money for just 1 year to pay your landlord, you have no business in the equity market, irrespective of the returns in the equity market, because you want to get your principal back without fail in 1 year. So even if stocks are doing 100,000%, you can't go there because that stock can do 0% the month you want to take your money out. You see the point I'm going to. So it's not, you can't compare 100,000 in stocks to one. No. It's what is your objective? So if it's less than 1 year, you're not doing equities at all. What about risk? If you can't take risk, don't do equities, because if you don't want to invest in something that keeps you up at night, you don't want to worry, is this tongue? No, you don't want to do that. You want to be able to put money aside and ignore the principal for a certain amount of time. That's equities. Let's assume you're a younger person and you can take the amount of risk and you want to invest for upwards of 5 to 10 years. Now you're in the equity space, what we call the variable income space. The other space is the fixed income space. In the fixed income space, it's you know exactly what you're going to get. So if you take money to a bank or a broker and you buy a bond, you know exactly what you are going to get. Because you know what you're going to get, there's no risk, in quote unquote, of the investment, right? There's no issuer risk, or there might be. But because you know what you're going to get, your returns are lower. Because you know exactly what you're going to get. But when you do equities, you don't know if the stuff you bought could make you 100% or 0%. Hence, you have a higher expectation of returns in variable income. And the way to make money in variable income equities is time. Because when you invest in a Tesla, he's going to lose money because it's growing. So you're going to make loss. Amazon made losses. Look at Amazon for many years before they turned a profit. Any company that is making profit immediately it starts to do business is a red flag. Because that means what are they? They're not really making any investments. They have to take that profit and reinvest in the company, which means you make no cash flow and probably a loss because they are reinvesting in capital to make more money in the future. So loss is not a problem. It's why are they making a loss? If I hear a company made a profit but made a loss because they don't have to put the profit back to buying a new factory, that's perfect. So you want to find out, if you then invest in that company and you say, wow, they made a loss and after 5 years, I sold my shares at a loss. You've lost out. You've got to find out why they're making money so that when you are in that company, after 5 years, that fact now comes on stream, earnings go up, your share price then goes up. That's why they ask you to stay longer in equities. The longer you stay, then those investments that you have invested in at the very beginning come to fruition, it hits earnings, and it makes money for you. That's how you want to approach it. Who are you? Why are you investing? That tells you where you should invest. If you don't know what to do, that's why I give you the ETF play. If you don't know what to do, let's say you want to keep this very, 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 very simple. I'll give you 2 stocks. Very, 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 very simple. VT, Victor Tango, and BND, Bravo, what's N? Bravo November Delta. BND is an ETF that buys only fixed income. VT is an ETF that buys only stocks. So you have VT, you have BND. Okay, just change the percentage. If you are younger, you want to do more in VT and less in BND. As you start to get older, you start to replace the equation. You do more of BND stocks and less of VT. It's very simple. So what you're doing here, you've bought a lifetime investment product. It says, I'm 25 years old. Subtract your age from 100. So if you are 22 years old, 100 subtracted by 22 years, that number you get, you buy the VT. The other number, you buy the BND. As you get older, you keep on readjusting till when you are 60, you have a preponderance of your investment in fixed income and less in equities. That's a simple way to do it. And what we've done is that we've tied your investment to who you are, your age, and your attitude to risk. When you do it this way, you don't care about the market going up or the market coming down. It's not your problem. You are investing according to your objectives, not chasing returns. If Nigerian stocks go down, you don't care. You are buying a good company at a good price because you have a 10-year horizon. If the stocks go down, it's an opportunity for you to buy more, average your costs downwards, and increase your profitability in the future. But if you're a trader, this is not for you. I don't talk to traders. They have a more higher skill level, so we can't do it on our Twitter space. I'm talking to guys that like to invest, not traders. So, Gospel, I said a lot there. I packed a lot of information there. I hope you can pick. It will be recorded, so you can go back and listen to what I've said and distill a few of things I've said. I posted the apps. If you go on my TL, I think it was last week, I'll retweet it again. I posted all the apps, even folks that talk about finance. even folks that you can follow and all that. Olumide is right here. He's been here 3 hours. If I have to pay him, I'll go broke, So you have to make an effort to understand. Don't invest unless you understand. Nobody's going to buy a car without looking at the manual or going to look at the car physically. So don't invest money because your friends are investing. Have at least a working knowledge of what you're doing. Even YouTube is for free. Put how to invest on YouTube when you're going to work. Listen to it on your headphones. Have an understand what is a stock, what is bull market, what is coupon. At least have the base. Don't just invest because you want to invest or you want a Twitter space. You've got to have your own personal responsibility to understand what you are doing. Then you invest, right? And then you're on the right path to getting that done. All right, Gospel, that was a long answer, but I tried to pack a lot of things inside. So let me go back to Olumide. Olumide, Gospel, thanks so much. Olumide, let's have your closing, and then from there we'll close, and then we'll just thank everyone for attending.
Yeah, I think you've said everything. There's nothing really much to say than people should just look at investing not for only making money, but intellectual building. You learn a lot. Look how the things Carlo have said. You keep learning every day, and it also sharpens your ability to see the global economy in a more productive way. Because the truth of the matter is that we can't build successful businesses. There are a lot of people that are not even good at building businesses, but you can bet on successful people. So investing is a very good path, and that's one of the reasons why I rarely criticize successful people, even when they make mistakes. You look at the likes of Tony Lumelu, for example. He has more than 5 listed companies on the stock market. Now, you understand how difficult it is to make money in Nigeria. Trust me, investors in Nigeria are also not easy. They will punish you when you're not profitable. If you look at Champs, for example, all this fintech bubble you are seeing there, you don't see that in the Nigerian stock market. Champs has been in the market for more than 2 decades, and it has a high sense of profitability. So companies have evolved. We have issues with our economy. I try not to mix the politics, and that's why I tell people, see, you don't really have to like the government to make money. You have to have the ability to separate your political bias from your business objective. So if you know that you really want to grow and learn, I think all the things Carlo have said will really bring things to shape. My final words is that as you lay your bed, you lie on it. We are in the world that information can make a difference. You don't have to have money to start to invest. An example of that, I had the passion just to read, listen, watch successful people and make it an habit. And along the line, I got some liquidity. So you don't allow your limitation limit you. Don't allow what you see on social media limit you. After all, most of the things on social media are just false. You really have to be disciplined, and that is my greatest fear. My greatest fear for generation is not about access to information; it's the ability to be content, to have contentment, and also the ability to be able to separate fake gold from real gold. So my parting week is have a nice week. Please stay away from trouble. We don't need to troll. It's been a very ugly week. I know it's financial space. It's been a very ugly week. I don't know why people will bring in tribe to investing or economic discussion. We are one. I've had good relationship with different ethnic groups. When you're out of the country, it's when you appreciate the unity of Nigeria. You can't be successful when you have that kind of myopic mindset. Success doesn't just come with making money. Success comes with the way you relate with people. When you relate with people poorly, trust me, you will not invest successfully, because when your emotional ability to be able to control the things you say, you can. That's why you see. Look at Warren Buffett. Look at the way he talks. Look at the way he behaves. Look at the way he spends. Look at the way he talks. These are examples of successful people. You cannot see an irrational person that will just throw. It's rare. So you really have to build your emotional and mental capacity. Thank you, Carl, for having me on this space. Have a nice week.
Perfect. And then again, thanks for just always being available to share and to attend. I do appreciate you guys. All right, guys, we're going to wind down. We've tried to talk about how to analyze and invest in public offers. We used FCMB as a case study, but you see how the discussion goes. We went far and beyond. We talked about ETFs, how to invest, where it's in just, we want you to start to invest. Like I said, the greatest asset you have is time. It's not interest rate, it's time. The first stock I bought in my life was a Standard Bank public offer. When Standard Bank was leaving Nigeria, they were selling their shares at 3 naira 25 kobo. I used 500 naira to buy that stock. 3 naira 25 kobo. Do you know why I bought it? Because it was also selling it for 50 kobo. I thought I could buy it for 50 kobo and then go and sell to my friends for 3 naira 25 kobo because I watched Wall Street. I didn't understand what they were doing. That's how I started to buy stocks. 3 naira 25 kobo First Bank. If you can do the calculation, I tried to do the calculation myself. I could not calculate how much I would have made if I did 500 naira with all the public offers First Bank has done from that day. I think I sold those shares in 2008. I tried to do the calculation. I could not do it. It didn't fit the calculator. 3 naira 25 kobo, that was the share price for Standard Bank when they were leaving. So the point I'm making is that unless you invest, then it can't grow. You know the Bible parable, the guy put the money in the ground. He didn't invest it. You've got to invest it to have a chance, right? And now I'm giving you a way to invest without taking too much risk. You can put a stop loss, you can buy an ETF, but you have to get into the game because inflation is a problem. If you don't invest, your money will not pay you more than inflation. That's the problem for you. All right, guys, this space is going to be recorded. So once we're done, it's going to be on the podcast. The podcasting is on my TL. Look out for it. It's also going to be on YouTube. If you want to do more, there are lots of books I recommend. I have the hashtag FinPlan books. Lots of books in there. You can go in and grab them. I also have a book. I wrote it for Nigerian market. Lots of international concepts, but I wrote it for the Nigerian market. It's very simple. Got lots of pictures. It's all my years, 22 years managing money in Nigeria and in America. I distilled to a book. I'm not trying to market you. The price has not increased since I released it. It's still 18,000 naira. It's not for profit. I'm writing the book. It's to educate. It's still the same price since 2002. Still the same price, 18,000. Get it at Roving Heights or order on Amazon. Give it to a friend as a gift. They would appreciate you. On that note, guys, thanks for allowing me to come into your space one more time on a Sunday evening. We're going to be here again next evening. Like we're always here being talking about money, finance, and of course capital market. And I hope I see you guys then. We'll keep on talking and learning together. I appreciate you guys all. You guys have a great evening and enjoy the rest of your week. Thank you, Lumide. Bye, guys.
Thank you so much.
You're welcome.